The administration is looking for that last bit of pressure to get these deals where they want them to be.
This is a perpetual negotiation that we'll continue to see unfold.
This is President Trump at his best, bringing the pressure and supporting his negotiators.
The market is trying to operate like this is going to be a nothing burger, but we are seeing tariff rates go up.
As the days and weeks accumulate, we're going to get greater certainty around what the trade policy posture is going to be.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, the trade deadline slides.
The president will also sign an executive order delaying the July 9th deadline to August 1st. So the reciprocal tariff rate or these new rates that will be provided in this correspondence to these foreign leaders, there will be additional letters in the coming days.
President Trump's new tariff threats look just like the old tariff threats. As the European Union rushes to put together a deal before the new deadline, Secretary Besson is preparing to meet with China for another round of talks. Similar tariffs, very different price action.
This is a market that has the picture. This is a negotiation. It's escalate to de-escalate. There's sort of a fool me once, shame on you. Fool me twice, shame on me, because this is a market that has seen this story before. And each deadline becomes another delay for this perpetual policy of uncertainty. And that is the key question that I have. How do companies and how do investors adapt to that type of environment?
I totally agree with you. I think two big disappointments for a lot of us. One, July 9th is not going to be a clearing event. This is going to continue. And two, if you were hoping for cuts from the Federal Reserve, this makes it harder for this Federal Reserve to cut interest rates.
Absolutely. What we've heard from Jay Powell time and time again is we don't know the tariff rates. There's a lot of uncertainty. So it's making us basically say frozen in place when it comes to policy. Well, guess what? How difficult is September going to be for them to potentially cut, which a lot of people were excited about. If we're not going to get the tariff rates at this moment, we think August 1st. And if you see April 2nd become July 9th, July 9th become August 1st, who's to say that August 1st also might not slip?
For the threats to be credible, you have to believe there could be some follow-through. And based on the price action of this morning and yesterday, it's difficult to believe that a lot of people think there's going to be follow-through.
A note from Citigroup coming out. We still expect to deal with South Korea. South Korea saying we view this as a negotiation and we'll be at the table. You've got Japan saying we're not going to take a bad deal. You have a European Union about to maybe make a deal in the next 48 hours, whatever that means. And then the details, of course, have to get worked out. There's a key question here about what the final outcome looks like and whether we have adjusted to this idea of a base tariff rate that is materially higher to pay for the deficit as sort of a policy, not necessarily some sort of negotiation.
Also, the president's rhetoric last night was very wishy-washy. Quote, I would say firm, but not 100% firm. If they call up and say we'd like to do something a different way, we're going to be open to that. But essentially, that's the way it is right now. If you want to play ball, you have to. This is what you have to pay. Right now, with these 14 countries, which basically, essentially, the tariff rates did not change, just the dates, he is in negotiating mode. I'm waiting for the other deals to potentially drop. With these countries like India, like the European Union, like Switzerland, that we have seen the United States deeply engaged at the negotiating table.
So far, not much change in the equity market, at least this morning. Unchanged on the S&P 500. Lots to get through this hour. Coming up on the program, we'll catch up with Ed Yardeni of Yardeni Research as stocks look to bounce back. The former NEC Deputy Director Everett Eissenstat as President Trump buys time. And Kelsey Berro of JPMorgan on the odds of a September Fed rate cut. We begin this hour with stocks little changed as traders face down the latest tariff threats. Ed Yardeni of Yardeni Research is optimistic, writing, we tend to be perma bulls because there are so many more perma bears. We focus on the positives and frequently find them to be more compelling than the negatives. Ed joins us now for more. Ed, welcome to the program, sir. Let's talk about these tariffs first up. The tariffs themselves and the threats look very similar to what we heard on April 2nd, right, but the price action is so different, Ed. What explains that?
Well, Liberation 2 is, been there, done that. That's really what's going on here, is the market figures this, as you folks said, this is, the art of the deal. It's negotiations. Let's not forget that Trump's background is commercial real estate and residential real estate in New York City. And, they do a lot of negotiating there between other developers and politicians and labor unions. And they scream and they shout, but all that happens, all that bullying and negotiating occurs behind closed doors. Trump has taken this to another level and to a global level of negotiating publicly with leaders around the world on trade. So it's not a pretty thing to watch, but I think the markets have figured out that this is going to get resolved in the next few months. It has to be, because otherwise Trump's going to really risk losing the midterm elections for the Republican Party, and that's not going to be good.
What if it doesn't, Ed? What if it isn't resolved? How do you think markets handle an extended period of ambiguity? And what would you expect corporations to tell us in the upcoming earnings season?
Well, I think, first of all, when it comes to all this impact on the United States, so far it's been remarkable. The resilience of the economy has been absolutely remarkable. I've been in the resilient camp, and I'm in awe at how well the economy is hanging in there, how well consumer spending has been hanging in there. And I'm also in awe about inflation. Inflation really hasn't picked up. Some of the indicators for July suggest that it's actually going to be pretty close to zero during that month. It's a little early in the month, but there is sort of a nowcast for that. So all in all, I think the U.S. stock market is doing what it's supposed to do. It's supposed to take the long view, and the long view is still quite optimistic, I think, with the technology revolution we're in, the digital revolution we're in, and likely to continue to have very positive impacts on the U.S. economy and productivity.
For a perma bull, your recent note was pretty bearish, and it really focused in on the labor market and the fact that private industry payrolls rose only 74,000, which was the lowest in your data going back to 2004. And this points to something happening under the hood that isn't the sort of equilibrium that can keep on going for a longer period of time. Why do you stay bullish, even with that factor?
Well, to maintain my credibility, I do make sure to constantly write about what the bears are saying. And I was actually a little surprised that there wasn't more bearishness for the economy anyways, and the stock market, about the employment numbers that came out on Thursday. And they were weak. When you take out government employment, and a lot of that was education employment, maybe we're hiring a lot of teachers and getting them ready for the new school year. Maybe the schools have been overwhelmed with kids of migrant workers, and so they've had to load up. So maybe that's a real number. But take out government employment, and we're up only a little over 70,000 in non-farm payrolls. So I did point all that out, but then I put a positive spin on it and concluded, this is the economy has been stress tested by tariff man, by all this tariff turmoil that we've had. And yet it's passing the tests. The banks have passed the tests. And so, I kind of stick with the data. And the data, on balance, I think, suggests that we probably will see some better employment numbers and a better economic growth in the second half of the year.
Just the counterpoint to this, and I can already feel people rolling their eyes at the sort of bearish counterpoint. There is a fear that the market isn't responding to bearish news, that there isn't some sort of sell-off, that there isn't a response function because people have been trained not to be bearish, because the bulls have won out again and again, and people just keep leaning on all the liquidity in the market. But a lot of that liquidity is going to have to go to financing some of the fiscal deficit around the world of developed markets. How much does that factor in? How much do you start to watch that and say, hold on a second, something could be brewing here?
Well, you can look at the fundamentals. You can, I guess, put together a list of everything that's bearish, that should take the stock market down. And then you can also look at the stock market and say, why isn't it going down? And I think first quarter earnings were much better than expected. Second quarter earnings, it's a layup. They're going to be better than expected because expectations are so low. And so I think that's going to be quite good. And then we are seeing that the president's tax bill was passed. It's an extension of the tax cut, which is bullish for the economy. In addition, from what I understand, if you want to build a data center, you can build it and depreciate the whole thing, expense the whole thing in the first year. I think I got that right, but I'm still checking that out. But I think, in other words, there's a lot in that bill that is in fact quite stimulative. The president has in fact brought a lot of money committed to onshoring in the United States. There's a lot of positives going on.
Ed, when it comes to what's going on in the financial markets, Liz Ann Saunders of Charles Schwab contemplates this in the Financial Times. On top of a Trump put, she says maybe there's this potential for a Trump call. Do you think that means that we potentially get a more aggressive White House when it comes to policy?
Well, I think certainly the Treasury seems to be on the verge of financing more of the debt with Treasury bills, which I think is why the bond market yield hasn't gone straight up. It's been going up somewhat here, and I think it's still consistent with my view that the bond yield should be trading around 4.5% through the end of the year. So I really don't have a problem with this backup in bond yields the past couple of days. But the Treasury seems inclined, based on what Trump recently said, to finance a lot more in the Treasury bill market, then wait until they have their loyalist as the new Fed chair and hope that the loyalists can get interest rates down. So I think a lot of the action is going to be on how we're going to refinance the debt.
Ed, where are the bond vigilantes? You coined that term. A lot of people have been saying they're in hiding. They're not doing their role. They're not picketing. We're not seeing those protests. Are they going to show up, or is that sort of an outdated term?
No, I don't think it's outdated. It's, I coined it back in 1983, so we're talking about it now, and it's still relevant. However, the important thing to recognize is the bond vigilantes are not the only force in the bond market. There's the Fed, there's the Treasury now, and of course foreign investors. They're all important influencers of what happens in the bond market. I think the bond market it's hard to really short bonds here when you've got the President of the United States on Fox News saying that he's going to finance the next several rounds of debt, government debt, that he's going to refinance it with T-bills. We saw what happened back in November 1st of 2023 when Treasury Secretary Janet Yellen at that time did the exact same thing, and the bond yield, which got up to 5% in late October, just took a dive on that news. So it's hard to be a bond vigilante when you're fighting the Treasury.
They are not in a position to extend duration right now, that's for sure, Ed. Thanks for your time, sir. Ed Yardeni of Yardeni Research. Looking at the 10-year this morning, slightly softer, yields higher by 3 or 4 basis points. Let's call this 4.42. Just on the equity market, thinking about earnings season coming up, Max Kettner of HSBC put this one out yesterday. The bar to beat is very low going into earnings season. The big story in July, not this week's tariff deadline. It's the start of the reporting season next week. Any dip this week has to be bought very quickly.
July 15th, kicking off with JPMorgan and the bank earnings. A lot of people are expecting the earnings to be just like Ed Yardeni said, much better than expected, as they were in the prior quarter. And how much of a boost that gives really is that low bar that a lot of people are saying is easy to step over.
Equities doing okay so far this morning, just about unchanged on the S&P 500. With an update on stories elsewhere this morning with your Bloomberg brief, here's Lizzie Burden. Hey, Lizzie.
Hey, John. President Trump delayed imposing higher tariffs on US imports until August 1st, while sending letters to countries detailing the levies that they'll face. The letters include 25% tariffs on goods from Japan and South Korea and plans for more than a dozen other countries. The president also teased the possibility of further talks ahead of the new deadline. And elsewhere, Apple's top executive in charge of AI models is leaving the company for Meta. Sources telling us here at Bloomberg that Roming Pang is joining Meta's new superintelligence team after being offered a package worth tens of millions of dollars per year. And President Trump says that he'll travel to Texas on Friday to see the devastation from flash floods, which killed at least a dozen people, 100 people, and left dozens still missing. The deaths include at least 27 children and staff from a summer camp. Recovery teams expect to find more victims as a search continues. That's your Bloomberg Brief. John.
Lizzie, thank you. Appreciate the update. More from Lizzie later this hour. Up next on the programme, the White House buys some time.
The president will also sign an executive order delaying the July 9th deadline to August 1st. So the reciprocal tariff rate or these new rates that will be provided in this correspondence to these foreign leaders.
Up next, we'll catch up with Rob Casey of Signum Global Advisors, live from New York City this morning. Good morning. In yesterday's session, snapping a two-day winning streak on the S&P 500, the biggest one-day loss going back to mid-June. This morning, not much price action to speak of, pretty much unchanged on the S&P and positive by about 0.1% on the Nasdaq 100. Under surveillance this morning, the White House buys some time.
The president will also sign an executive order delaying the July 9th deadline to August 1st. So the reciprocal tariff rate or these new rates that will be provided in this correspondence to these foreign leaders.
All of those, to understand it correctly, are now deferred to August 1st, right?
Correct. There will be additional letters in the coming days. He is literally looking at the map and looking at every country on the planet and seeing where they are ripping off the American people.
So here's the latest. The White House confirming that President Trump delayed increasing duties on key trade partners until August 1, but threatened new tariff rates on countries including Japan and South Korea. Bloomberg's Tyler Kendall joins us now from Washington for more. So Tyler, explain the difference between what we heard yesterday and what we saw on April 2nd.
Yeah, hey, John, good morning. Well, by and large, the tariff rates that were outlined in these letters to more than a dozen countries were basically in line with what we saw on April 2nd. Some were marginally higher, Japan, for example, by 1 percentage point, but many were the same, including South Korea as well as Indonesia and South Africa. It is worth pointing out that some were actually pretty lower, including Laos and Cambodia, the latter of which saw the largest drop from 49 to 36% when it comes to threatened tariffs. Now, we're really going to be watching to see if more countries come into this picture and if their rates change in a meaningful way. Bloomberg Economics says that this initial wave of tariff letters, these countries account for about 15% of U.S. imports. So there's still a lot of other trading partners out there. And you heard the White House press secretary indicate that there could be some more letters going forward here. Now, some of the things that we are watching when it does come to potentially how these tariffs could ramp up is that, well, all of these letters had a few different consistencies. One is that President Trump threatened that there could be higher tariffs if there are transshipments of goods. Of course, big questions here going forward about how that could be enforced. And then the second is any sort of retaliation. John, President Trump said that the U.S. will just slap on an identical rate if any country does retaliate in response to these letters.
Tyler Kendall with the latest down in Washington. More from Tyler later on this morning. Bramo, the difference. April 2nd, 24% on Japan. July 7th, 25% on Japan. All these tiny little differences between where we were back then and where we are now hardly make a difference.
But there is a difference in terms of the timing and what the market and all of us have experienced, which is a deadline's not a deadline. And that, I think, really set the tone for the path forward.
Let's build on that conversation with Rob Casey of Signum, looking at tariffs and writing the following. Consensus currently is that July 9th will simply become August 1. However, we would suggest being cautious around this view and staying on guard for tariff snapbacks sooner than then. Rob joins us now for more. Rob, good morning.
Morning.
You said it. A lot of people are feeling it. We can just look through all of this. Lisa explained it perfectly. Why do you think there is a risk of actual follow-through here?
Well, I think there's a risk of follow-through, A, because President Trump has not gotten the concessions that he wants in private negotiations or in public negotiations with posting these letters. And he is potentially running out of room, right? We may get a court decision on IEEPA this fall. Trump essentially has the opportunity to negotiate between now and then. So they're telling us they're getting closer, right? And maybe we get a bunch of deals over the course of the next week or today. If not, I think they probably want to push their advantage before, caving or taking a step back.
What's the deciding factor that dictates the shape of those deals? What's the difference between becoming the UK or Vietnam or Japan? What's the difference?
Well, I think that's clearly an open question. What we've seen in the UK deal, the Vietnam deal, among others, is, frankly, they're not very detailed. So I think that the deciding factor is the leader on the other side of the table is willing to accept what President Trump wants in broad terms, in vague terms, and maybe they're able to sell it to their domestic constituency, and then Trump is able to come back to us and say, we made a good deal. But that's not to say that these are, even the trade deals that are struck, they're still not very detailed.
When you talk about concessions the administration is looking for and they haven't received them yet, what exactly?
Well, across the board, I think there are really two. Trump wants to be able to message that he's bringing down tariff levels on U.S. goods being exported elsewhere. He wants to message that he's decreasing the trade deficit with individuals. I think that is probably the one with individual countries. That's probably the one that's going to get the most play from President Trump so far, because even when he's announcing, 25% on Japan, 25% on Korea, he's saying these tariffs are not enough to rectify the trade deficit. So he's still focused on the trade deficit. He still sees it as a problem, even at these higher levels.
When you look at things like the United Kingdom, Vietnam, even the slew of deals we saw on his Middle East trip, What happened to all of them? What is the process that's now happening behind the scenes within the administration to actually make sure the details of the deals get done? Who's working on that?
Well, I think it's behind the scenes, Annmarie, for a reason, right? We're not 100% sure.
Do they even have the staff?
Well, that's what I was going to say. Is 90 days ago, we heard 90 deals in 90 days, right? And that sounded impossible then, and clearly it was impossible, right? Not every country that has tariffs to be applied, today or August 1st, not every country has even had FaceTime with the president's administration. And so if you're a country saying we haven't even had the chance to negotiate, and now we're getting these tariffs slapped on at a higher level, like what are you supposed to do with that? So I think it's clear that there is not the bandwidth maybe that they had expected, because these deals aren't quite as easy as Trump, Best and among others, hoped.
There might not be the bandwidth. There's also a question about the framework and what kind of framework they're using to really understand what to extract from different trading partners. It's, buy more rice, buy our chickens, talk about, car exports. There's this question of raising the ante and using it as sort of a national security tool as well as a trade tool. Have we gotten any clarity around what the framework looks like?
Not a lot of clarity. I think one thing that we can see from both the UK and Vietnam is that President Trump wants to come back to the U.S. and message that we are able to send more goods elsewhere, right? And that's, broadly speaking, so far, I would say, mostly focused on the U.S. farm, ag industry. We also want to be able to sell more cars elsewhere, export, build up manufacturing capacity in the U.S. I don't think we can forget about a general goal of building up manufacturing capacity in the U.S. Each individual deal may not get us that much closer, but I think that's the overall trend, at least that President Trump is hoping for.
The goal is also to raise revenue, and this is sort of a key component with the one big, beautiful bill, and we did see the tariff revenue surge to a record $24 billion in May. How much is that sort of a sticking point at this point? They kind of have to keep rates high.
Totally. I think it's a major priority. Obviously, we don't really hear that from the White House, right? Because if we're talking about tariff revenue, then we also have to be talking about who's paying that revenue, right? And a lot of times, not all the time, but a lot of times, it's the American consumer. But the truth of the matter is, on the back of one big, beautiful bill, right, we are still in a deficit crisis. And so we have to find money somewhere. We didn't find it in higher taxes. We didn't find it in reverting to pre-Trump tax cut levels. We're going to have to find it elsewhere. And I just have to say, there is revenue to be had with tariffs, of course. But there is, I think, a broader point to make from now until August 1st, and that is, if we don't have the 145% on China, right, then we really are looking at only a marginal, I don't want to call it marginal, it's more than marginal, but we're not looking at a drastic increase in tariff levels, which means we're not looking at a drastic increase in revenue levels as well.
Did you mean to call it a crisis, or was that a slip? Because in
It's
the last
early.
week, we just passed a multi-trillion-dollar bill. It's hard to call it a crisis down in Washington. What makes it a crisis?
Well, the deficit may not be in crisis, right? Because we've run wide deficits for quite a long time, and we're all still standing. But the truth of the matter is, I don't think Republicans have a solution to the deficit, what they call a deficit crisis. Trump came into Washington describing the necessity of bringing the deficit down. Of course, we can all sit here and say that Democrats have failed to do it over the previous 4 years, but it's pretty clear that Republicans are going to fail to do it, at least in this Congress, and I think very likely over the course of Trump's term.
They're certainly not behaving as if it's a crisis in Washington.
And they just passed a bill that is deficit expansionary. The U.S. is going to be selling a net more than $220 billion net over the next 5 weeks alone. This really raises a question, again, where are the bond vigilantes? Are they just pegging their hopes and dreams in the fact that the Treasury is going to sell it all in T-bills? I guess so.
It's not in the bond market this morning. 496 on 30s at the moment. Yields are marginally higher by 4 or 5 basis points on a session. Rob, it's good to see you. Thank you, sir. Rob Casey there of Signum Global Advisors. Coming up next on this programme, the former NEC Deputy Director Everett Eissenstat, as President Trump signals he's open to trade negotiations. Plus, Yahira Anand with your morning movers this morning as Tesla shares look to rebound. That stock is higher by a little more than 1%. Michael Zezas of Morgan Stanley and so many others absolutely nailed this. Kick the can was the base case. Kick the can is exactly what we got just yesterday. Equity futures on the S&P 500 so far, little changed on the S&P following yesterday's losses. On the Nasdaq 100, firmer by 0.2%. With 3 hours until the cash open, let's get you some morning moves and cross over to Yahara Anand. Hey, Yahara.
Good morning, John. We start with renewable stocks. They are lower in the pre-market. That's because yesterday Trump signed an executive order calling for even tighter limits on clean energy tax breaks. That's after those incentives were already scaled back in his $3.4 trillion budget. So as a result, you are seeing First Solar down 2.2%, Sunrun down 5.5%, while Enphase and Solar Edge are also lower. Moving on, we have Tesla, worth taking a look at after the stock fell 6.8% yesterday on that news that Elon Musk was forming a new political party, drawing fire from President Trump. But today it is bouncing back up about 1%. I will note that the next big catalyst for this stock is about 2 weeks away on July 23rd, when Tesla reports earnings. And I want to end with Nike. Shares are slightly lower, down 0.6%. That's after President Trump sent letters to the likes of Cambodia, Indonesia, and Thailand saying that they will see a 36% tariff if they don't strike a trade deal with the U.S. These are the exact places that Nike and other shoemakers and apparel makers diverted production to in order to diversify away from China. And this, of course, comes on the heels of that Vietnam trade deal, which cut expected tariffs down to 20%. That did add some certainty for the likes of Nike, but this is also a company that's in the middle of trying to stage a turnaround. John?
Yahara, thank you. More from Yahara in the next hour. On our radar this morning, our top story, the president ramping up pressure on trading partners, posting letters to several nations threatening high tariff rates that would go into effect on August 1st. Trump then saying the deadline and tariff rates are not 100% firm.
So obviously what you see right now is another fluid situation. The dates keep changing. It was supposed to be 90 deals in 90 days. Maybe they'll get 90 deals in 113 days. We don't know. What is obvious is that they don't have the bandwidth, especially speaking to Rob Casey. They don't have the bandwidth behind the scenes to go after all of these countries at once. We are still waiting on actual firm deals and what the framework will look like for these firm deals. Do they take a Vietnam approach? Do they just take a de-escalation approach like they did with China? Or is there actually some sort of deal on the margin, like when it comes to United Kingdom, when they actually discuss specific rates and agricultural going in or out, cars, et cetera? So many questions when it comes to what is going on with the trade policy.
For a company, what does this mean about trying to come up with policy and strategy going forward? How do you invest longer term? How do you understand where to make your goods? Do you just expect that they're going to be higher bills as a result of them? Do you start charging them? Do you start front loading as quickly as you possibly can in the next 3 weeks? Does a policy of uncertainty have a drag? And that, I think, is really going to be one of the key questions.
That's the C-suite. We've got to think about the policymaker as well. We'll find some space this morning to talk about the Federal Reserve, whether you think they should or shouldn't cut interest rates. Put that to one side. They've established their threshold to reduce interest rates. They want to know what the policy is, show me the tariff, and then they want to see the outcome of the tariffs and just wait and sit for a little while. The fact you've extended this from July 9th to August 1 makes it difficult to do anything. They certainly can't signal anything at the end of the month because at the end of the month, they still won't know what the tariffs are.
That's a moving goalpost. And so the Fed's policy roadmap is going to have to also be a moving goalpost because they're going to say we have to operate with a modicum of uncertainty and make that call without that data, because that's essentially what they're being tasked to do.
Lisa mentioned the corporate response. Worth going through the corporate reaction so far. Porsche warning of a challenging road ahead after reporting a slowdown in US sales and persistent weakness in the world's #2 economy, China. Global deliveries falling 6% in the first half of the year, led by a 28% slump in the country, driven by fierce domestic competition.
So this is where it gets complicated. How much are companies going to use tariffs as a fig leaf to cover up a whole host of other issues? And there are a confluence of issues in the auto sector, competition from China, the transition to electric that's coming at a time that's pretty fraught in terms of where you get the materials, in terms of the U.S. policies. And Porsche is at the epicenter of all of those. In terms of tariffs, they should be the ones to weather it the best, because ultimately they can pass along the cost, because if you're buying a Porsche, you could probably afford a couple extra $1,000. So that's the reason why I'm watching this as sort of the excuse, sort of the currency differentials that people use sometimes, or other types of platitudes to cover other strategic issues that they're facing.
You think it's fair to say for the European brands, the bigger challenge right now is not the tariffs, it's the competition in China?
100%. If you take a look at the exports from China, they're not necessarily going down. They're just not going up to the U.S., but they're going up everywhere else around the world, including to Europe.
When you look at what China's doing in BYD, they actually unveiled in December a prototype that looks like the Porsche 911. It is incredible what they're unveiling. And obviously they're at a cheaper cost if you're buying in China. And that is why you see just basically off the cliff sales when it comes to Porsche.
That's the latest on Porsche. If you're waking up this morning on your way to school, college, whatever it might be, and you're thinking about what to do, earn some cash, if you want athlete money, join Meta, going all in on efforts to reshape its AI leadership, with the company hiring a top executive from Apple at an offer worth tens of millions of dollars per year. The CEO, Mark Zuckerberg, has reportedly been heavily involved in the recruiting process, and we've seen headline after headline over the past few weeks.
I would just argue that these aren't people who are, 18 and in college looking for a summer internship. But that said, this is the Trojan horse. And you said this, Annmarie, and I'm copying you because I think that it's brilliant. This idea of, rather than buy one of the competitors, just hire all of their top talent and hire it from the weak players. Sort of like going after blood in the water. Apple really having trouble getting off the ground with their AI offerings. Well, just take their high talent and, call it a day. And I wonder how much they're going to benefit from
He's
this.
gone after the strong players too.
Yeah.
Over at OpenAI. Look, I think this is Mark Zuckerberg essentially telling us all he sees this as a real existential risk to his company. Winner takes all, and he's willing to pay whatever it takes.
And he's been right. He was right with Instagram. He was right with a whole bunch of other acquisitions. And frankly, a lot of people, if you take a look at the performance of the stock, are betting that he'll be right again.
Meta this morning in the pre-market higher by 0.6%. We'll come back to that story a little bit later. Let's turn back to trade. President Trump unveiling new tariff rates on trading partners while delaying the deadline to August 1. The former NEC Deputy Director Everett Eissenstat writing, one thing remains clear. The president is laser focused on achieving balanced trade through reciprocity and committed to aggressively using tariff authority towards that end. Everett joins us now for more. Everett, welcome to the program. We're trying to understand how different August 1 will be compared to July 9th, which hasn't happened yet. What will the difference actually be?
Well, good morning. We'll have to wait and see. I think many people believed and hoped that this July 9th postponement deadline, when it ended, we'd have greater certainty and clarity as to which countries were going to be able to negotiate a framework agreement with the president and which might get higher tariffs. And we don't know today. We know that certain countries will have their tariff rate set. There have been some letters that have been issued. But then again, the president reserved the right within those letters to raise those tariffs up and down, depending upon the relationship with the country. So there's still a lot of story to be told. There's still a lot of negotiations to go on. And we'll just have to wait and hopefully we'll see some more deals come out between now and August 1st.
I think it's fair to say it's very ambiguous. And when you look at some of these letters, Japan was 25% as of yesterday for August 1st. April 2nd, it was 24%. Kazakhstan was dropped from 27% to 25%. Tunisia, 28 to 25%. You get the point. Why? Why are these rates like a percentage or two off from April 2nd? What is the methodology behind any of this?
Honestly, I think some of the methodology is to simplify the rates a little bit and to put them in buckets. And I suspect that what we'll see at the end of the day when we get a bigger picture of how many countries and what the tariff rates is, that they're going to be categorized by were they willing to put forth an offer? Was the offer made in good faith? What's the trade deficit? Obviously, that's going to be a key factor because he cited that repeatedly in his letters. So there's a number of tells there, but we don't know, and many of these countries don't know what they need to do or what they can do to find a pathway to stability, and that's what they want. You saw with Vietnam, they agreed to a 20% tariff. Why did they do that? Because it gave them some predictability for trading over the next several years, and that's something that's quite valuable.
Everett, basically what happened yesterday is the president came out and said everyone just gets an extension. Why put these letters out for certain countries?
Well, I think the reason the letters were put out is because those countries are the ones that he believes have some of the most pernicious trade deficit problems. And for countries like South Korea and Japan, those letters were probably quite shocking. Both countries have a special national security relationship with the United States, have a special trading relationship. They invest billions and billions of dollars in the U.S. economy, create many, many jobs, and they export from the United States. So I think they both believe that they would be treated a little bit differently and have some dispensation. The letters basically are saying, look, you need to take action, and the special relationship matters, but it's not enough to discount what the president sees as unfair trade practices.
Everett, is the United States losing leverage as long as this process goes on and the can keeps getting kicked?
the more leverage we can, leverage matters. We do have a lot of leverage. It's important to use it very strategically. And one of the best ways to use leverage is to demonstrate that it works. And that's getting a deal done, and a deal done that someone can look to and say, oh, that's achievable. I can do that. And it's a motivator. I think if this continues and there's no framework set and the tariff rates keep being pushed down the field, which I don't think they will be, that does over time lose a little bit of the leverage. And and perhaps, some economies just get resigned to say, well, okay, this is going to be my tariff rate. I'm going to adapt to that because at least I know that's predictable. So I do think that the leverage is something that needs to be used and used well, because over time, if you don't use it, you're going to lose it.
How much is this drawing countries closer to the United States versus pushing them away to form trade blocs with one another, if that's more of a certainty?
Mm-hmm. That was happening anyway. There were a number of countries that were coming together trying to form their own trade frameworks amongst themselves. And part of the reason was because it wasn't just President Trump. I mean, even under President Biden, there were no trade negotiations ongoing in the United States. You may recall, prior to that, prior to the first Trump administration, we'd negotiated a flurry of trade agreements and locked in very good outcomes with a lot of countries. This could put forward that kind of dynamic where countries are looking to negotiate amongst themselves. I do think, though, that the whole playing field has changed. The kind of agreements they're going to negotiate are going to be very, very different than they were, say, back, 90s, 2000s. They're going to be more focused on economic security, national security, secure supply chains, and they probably won't be as comprehensive as they used to be. So the president's definitely having a major impact on global trade, and also one that I think is going to last for probably decades to come.
Everett, we'll see in about 3 weeks, I hope. We'll catch up soon. Everett Eissenstat, there, the former NEC Deputy Director, out of the deal, exhaust the other person at the other side of the table, and they'll accept whatever you want. I think at this point, we'd all take 10, 15% and move on, wouldn't we?
Are you talking about us being exhausted by this process?
Investors,
exactly.
Countries, whoever it might be.
That said, they've got to move on, and they have to understand how to protect their industries and how much they've create side deals with other partners, and how much does it push people to say, look, can we really move away from China if we're not sure what the relationship with the United States really is going to be?
Also, Everett was talking about how the letters for South Korea and Japan were quite shocking. There's another school of thought. For Japan, actually, President Trump did a favor to the prime minister because they have an election at the end of July, and they could not have a trade agreement with the United States where they gave up key industries like you talk about when it comes to rice or the auto sector when you're up against serious, sensitive domestic politics.
It's well framed in the same way the president dealt with Nippon Steel and that situation going into his own election. Equity futures this morning positive by about 0.1% with an update on stories elsewhere this morning. With your Bloomberg brief, here's Lizzie Burden. Hey, Lizzie.
Hey, John. The president also hosted Israeli Prime Minister Benjamin Netanyahu at the White House last night. The Israeli leader told Trump he nominated him for a Nobel Peace Prize. The US is pushing for a ceasefire in Gaza that could end more than 18 months of fighting and see the release of the hostages still being held by Hamas. And more than 100 people have been confirmed dead in floods that tore through central Texas over the weekend. Local, state and federal officials have faced criticism in the aftermath of the tragedy. Senator Ted Cruz downplayed concerns that President Trump's cuts to the National Weather Service played a role in the failure to evacuate people. And Novartis has won regulatory approval for the first medicine specifically designed to treat malaria in babies. The drug maker says that until now, infants were treated with tablets meant for older children adjusted for weight. In 2023, the World Health Organization said that there were nearly 600,000 malaria-related deaths, with children under 5 accounting for 3 and 4 deaths. And that's your Bloomberg brief. John?
Lizzie, thank you. More from Lizzie in the next hour. Up next on the programme, the cost of prolonged uncertainty.
And the further we stretch out the tariff issue, the more likely it is that the growth issue will come first. So we are expecting slower growth in the third and fourth quarters and a rate cut by the Fed in September.
In just a moment, we'll catch up with Kelsey Berro of JPMorgan Asset Management, live from New York. You're watching Bloomberg TV. another sleepy start to a trading day. Good morning to you. Equity futures on the S&P 500 just about positive by 1/10%. On the Nasdaq, up by 1/4. Under surveillance this morning, the cost of prolonged uncertainty.
And the further we stretch out the tariff issue, the more likely it is that the growth issue will come first. So we are expecting slower growth in the third and fourth quarters and a rate cut by the Fed in September. 2s, 10s could move up another 30, 40 basis points pretty easily. There is room for further steepening of the curve. My concern is it might be more of a bear steepening at this stage of the game.
So here's the latest this morning. U.S. Treasury yields rising as President Donald Trump extends the tariff deadline to August 1. Kelsey, Berro of JPMorgan Asset Management writing the path of least resistance for the shape of the curve in both the U.S. and Europe continues to be steeper. Kelsey joins us now for more. Kelsey, good morning.
Good morning.
We'll get into the yield curves in just a moment. I just want to talk to you about something Lisa mentioned earlier this hour. What is the price of this prolonged uncertainty, moving this deadline from July 9th to August 1?
I mean, I think the price is probably a sub-trend growth environment, which is the environment that we kind of expect for the upcoming quarters. One where you have some things that are pointing to, upside risk to growth, particularly the one big beautiful bill. On the other hand, you have the tariff risks and the tariff revenue, which we would view it as a tax. And these things are kind of offsetting. Ultimately, it's kind of an environment where you're treading water. It's the same way that we describe the labor market, the low hire, low fire environment, one where you're just kind of stuck in the middle.
Is the Fed stuck in the middle as well?
Yeah, I mean, I think that's probably a good way to describe where they are right now. We don't think that they're going to be cutting rates in July. We've seen that repriced from about a 20 to 30% probability down to 0. That was a function of the July jobs report, which, while weaker under the surface, the headline jobs number around 150,000, the unemployment rate ticking down to 4.1. You kick the can down the road on that. The next question is, what are they going to do in September? We see the dynamics in terms of inflation and growth, and we hear the commentary from Chair Powell. I think it's actually been increasingly clear, which is that if it wasn't for the concerns around inflation and tariffs, the Fed would be cutting already.
It's sort of this interesting moment where people are looking at the long end of the yield curve and saying it should be steeper because of deficits, because of potentially a prolonged level of inflation. And then you have the Treasury Department saying we're just going to issue and finance our entire deficit on the front end. Can they do that? Would that be sort of accepted by markets?
Yeah, I actually think they can do that. So we've gone through and we've run the analysis in terms of how much additional supply do they need and can they fund that exclusively through bills. Ultimately, that is going to slowly reduce the weighted average maturity of their portfolio and going to increase their rollover risk over time. But we do think that they'll be able to keep coupon sizes the same and increase bill supply at least for the next 2 years. And that's a trend that you're not just seeing in the U.S., by the way, right? You're seeing that active management by the debt management offices, not just in the U.S., in the U.K., in Japan. They're all kind of dealing with similar issues.
Is this a backdoor way of monetizing the debt? Is this a backdoor way of saying we're going to issue on the front end and, by this way, we're going to pressure the Federal Reserve to drop rates as low as possible so that we can reduce our funding costs for the indefinite future?
I wouldn't put it that way. What I would say is, what we're transitioning to, and we've been transitioning to, is an environment where you started with mostly price-insensitive holders of fixed income to mostly price-sensitive holders of fixed income. So it was the central banks setting the price 5 years ago. It was the public sector that was the dominant driver of markets. And we're now moving into an environment where it's the private sector, it's the asset managers who are the price setters. And on the margin, they're demanding more term premium and higher yields.
What does it mean if you don't see some sort of rally on the long end in response to a lack of supply? If you don't see any, say, 30-year issuance or very little around the world, does that mean that yields go down, that actually there's more demand for that paper? Or does that render it just sort of an obsolete maturity?
Yeah, I mean, the adjustments in the maturities are not a silver bullet. So just because the Treasury is going to be focusing on bills doesn't necessarily mean that we should expect lower 10 or 30-year Treasury yields. But I think you always have to differentiate between, your structural view. You can have a structural view that yields over the course of a cycle can be higher, but that doesn't preclude that on a cyclical basis, yields can still move lower if we're seeing weakening in growth, weakening inflation, and the Fed cutting interest rates.
Well, when it comes to the Fed cutting, how challenging does now the moving goalposts of the tariff date make their decision? Especially also August 1st is when we'll get July payrolls. Is that enough time for them to cut in September, which a lot of people in the market believe?
It is tricky. Because, they've been saying all year, they've been on hold for 7 months, right? And they've been saying we need more clarity, we need more clarity. And maybe the clarity they're getting is the fact that they're not going to get clarity. And eventually they're just going to need to move forward with the information at hand. And I think the information at hand is going to tell them that ultimately additional rate cuts are expected. Or should be anticipated. And I think the real thing that we're focused on as it relates to the inflation is let's not debate from month to month. Are we going to see an increase in core goods inflation this month or next month? That's kind of a fool's errand. What is the broader inflation backdrop telling us about the strength of the economy? And when you look at services inflation, shelter inflation, the other parts of service inflation that are cyclically oriented, like airfares and lodging, they're telling you that cyclically the economy is weakening. And that's ultimately the signal that the Fed is going to be looking at, not the kind of one-time price adjustment risk from the tariffs that they were concerned with at in April.
Listening to the chairman, he's told us pretty clearly he's waiting because he thinks he can. He's waiting because he believes the economy's solid. If he's cutting in September, it's because it's not anymore. If they believe they want to wait and see what happens with the tariffs, they're going to have to wait beyond September. That's why I think if you're making a call now for September cuts, I think you've also got to make the call. There's got to be a degree of weakening of the economy at the same time, haven't you?
Yeah, but I think that you are seeing that weakening in the economy. So if you look at the payrolls report, if you exclude the government jobs, private payrolls was weaker than expected, and it was very concentrated in just a few areas. I think the other thing that caught my eye was hours worked continues to fall, right? So you may not be losing your job, but you're working less hours, which is an indication of less demand. And then I look at the consumption data. The consumer's been strong. They've been held up by decent income growth. But at the same time, the Q1 real consumption data was revised down. The Q2 real consumption data is tracking a little bit on the soft side. Now, we'll get more information on that in retail sales, which isn't this week, but next week. And so, I think that ultimately this is kind of a sub-trend, muddle along environment where the risk of reacceleration is not necessarily supposed to be your base case.
Which typically is a screaming argument by the 10-year and beyond, but it's not anymore.
Well, it's not about the 10-year. Now it's all about the short end. And right now there's a real question about the supply-demand dynamic and how much Treasury Secretary Bessent is the ultimate kingmaker in the bond market.
Kelsey, it's good to see you. Thanks for dropping by. Kelsey Berro there of JPMorgan Asset Management. Up next on the programme, Evan Brown of UBS, Sarah Bianchi of Evercore, the Daimler Truck North America CEO, John O'Leary, and ARK Investments CEO, Cathie Wood. Live from New York, the second hour of Bloomberg Surveillance. Up next.
We still prefer the U.S. equity market to other markets globally. The U.S. is also the single biggest destination still for dynamism.
We're uncomfortable with where multiples are, which is why we think that you're likely to have a pullback.
You're a gazillion miles away from a sell signal.
People are underappreciating the risk to the upside.
The next couple of months, you could see more volatility. But near term, you get the chase.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now, and your scores look like this in the equity market. Equity futures on the S&P just about positive by 0.1%. The tariff levels, the threats are very similar. The price action is very, very different. We were down 5%, down 6% following April 2nd. Nothing like it anticipating July 9th. As July 9th now becomes August 1, equity futures are positive by 0.1%.
The date and the moving goalpost more important at this point than any levels
signals that we get in terms of potential tariff rates, because they are temporary and they are not going on until August 1st. And at that point, we might have different ones to look at. This is a market that has gotten benumbed to every single headline. And it goes to the question, what will shock it? Rob of Signum Group coming out earlier and saying, ultimately, Rob Casey, this is going to be different this time. And at what point will this market wake up to that? Is that a possibility? And how much is this sort of training grounds for a complacency that we've seen time and time again?
It's a big subject of debate so far this morning. For the threat to be credible, it needs to follow through. And right now, a lot of people don't believe this president will follow through.
Which is why I was only having deja vu when I looked at the tariff rates, because they're pretty much the same as Liberation Day, maybe a percentage or two off when it comes to certain countries, but the market impact was definitely different. That idea of taco, Trump always chickens out, has really gotten a hold of the market. They think that this isn't credible because he'll just extend and delay yet again. What I think could be impactful for the market if it's to the upside. If Trump comes out and says, look, I got a deal with India, we're really close to a deal with the European Union, some big trading partners, that could potentially be changing when it comes to the trade story.
Lisa mentioned some of the companies and how corporations respond to some of this. I think they got a pass last earnings season on the calls just to say, we don't know, can't provide you with guidance. Do they get a pass this time around, this upcoming earnings season?
It's a difficult question, and it probably depends on the sector and how quickly some of the tariffs go on. So if the tariffs have already gone on, then you'll see where they've passed along price increases. We've seen that with certain retailers. If people have been able to hoard some of the products and then sell them at base prices, you're not going to necessarily see that read through. But really, this is the ultimate question. Have we seen the impact of the tariffs so far on consumer prices? We get CPI next week. And that's a key question. Some people saying, look, we can adapt and adjust and this is all just fine. And other people saying, just wait.
This week, we get to ask the airlines. Here's your week ahead. So July 9th is no longer that important. We've got some economic data. Jobless claims are doing OK based on the data we got last week. Delta Airlines report on Thursday. They gave us an early snapshot of some weakness that started to emerge in the economy earlier this year, back in February. What are they going to say later this week?
Probably some of the same. We've heard that. Although United came out and said a couple of weeks ago that they are expecting a rebound in the second half. They've been pressured by the domestic consumer base. And this goes to the question that we really have been grappling with. Is the policy of uncertainty and, frankly, some of the weakening that we were just talking about with Kelsey Berro, is that already showing up in terms of people being more discretionary about flying to Cincinnati and Milwaukee?
Lots of drama if you received one of those letters. No drama so far this morning in this equity market. Positive by 0.1% on the S&P 500. Coming up this hour, Evan Brown of UBS Asset Management staying overweight equities. Sarah Bianchi of Evercore as President Trump leaves the door open for trade talks. And the ARK Invest CEO, Cathie Wood, on Tesla's latest slide. We begin this hour with stock steady as President Trump signals he's open to more trade negotiations. Evan Brown of UBS writing, we think the market can look through this soft patch as rate cuts, fiscal stimulus and AI-led productivity gains set the stage for a better 2026. Evan joins us now for more. Evan, good morning.
Good morning.
Are you already done with 2025?
Yeah, that's right. I mean, we're not of this view that the economy is just going to sail through the second half. We think the economy will cool as these tariffs take effect. It's just the market gets that at this point. And the fact that the hard data will be deteriorating a little bit. The soft data is improving. And historically, when you have these kind of shocks, the soft data goes down first, the hard data follows. But once that soft data rebounds, the market kind of doesn't care about the hard data declining.
What's more important to you right now? Dear South Korea, dear Japan, dear whoever might receive a letter, or the earnings that we're going to see in the next few weeks?
Yeah, so we're less focused on the, each individual bilateral trade deal. What we want to hear is from the companies themselves and what they're doing, how much they're absorbing in margins, how much they're passing through to the consumer. Again, we expect effects. We don't expect these corporates to say everything is just fine. But at the same time, we've seen particularly U.S. companies just be remarkably dynamic and adaptable to what we've seen as a multitude of shocks over the last few years.
So John put me on the spot and I answered as best as I could, but you could answer it better. Are they going to get a pass again in terms of being able to give forward guidance of what the year ahead looks like and how exactly those tariff costs are going to be borne out?
Yeah, I think, look, it's still a moving target with the tariffs. And so, I think a lot of companies will say, oh, we're still working it out. We're still figuring out the exact layout here. But I think there will be, you can expect more specifics coming from these individual companies. But I think, as you said earlier, it's going to be a little bit more company by company, sector by sector, and less of a big macro issue and more of a micro issue.
We're trying to put a narrative to something, and I wonder if it's sort of a fool's errand on a lot of levels, but partly whether we're just looking at a rally generated by systematic fund rebalancing, whether we're looking at share buybacks, and just still a lot of liquidity in the system that needs to go somewhere more than we are any kind of cohesive economic or policy narrative.
Yeah, look, we go on TV and we like to, like you say, put narratives on everything. I will absolutely admit that there is a huge technical angle happening here where you essentially had the market completely freak out and capitulate with Liberation Day. By some metrics, same kind of capitulation that we saw 2008 and in COVID. And then now there's this massive chase. And look, I mean, there's $7 trillion in money markets, and that money is going to have to come in, as you said, systematic strategies.
Hold on a second.
Jumping in.
Everyone's been saying that.
Yeah.
I beg to differ. If there's risk there and you're getting paid 5% for cash, at what point is it not going to go into equities? Is it not going to be some sort of boost, but frankly, an investment in itself?
Yeah, I mean, in the end, we'll talk about different valuations and what you earn and everything like that, but in the end, it comes down to risk appetite. Right? Markets are behavioral. So love to put fundamental stories on everything, but the market has been going higher, and that's going to pull people in, and it will take a meaningful shock, I think, to disrupt that. Now, I've said that the hard data, we're okay with it coming down, but if the big risk is we just have the economy completely wrong and the labor market breaks. Now, it doesn't look like that's happening. We saw a decent labor report on Thursday. But that, I think, is the key risk here more than the tariff noise.
On the policy side, what could be the catalyst to the upside or the downside? Because you correctly note that basically the tax cuts and the tariffs cancel each other out.
Yeah, so I think so the tax cuts and the tariffs, it's kind of a sequencing issue. The tariffs hit right now. That hurts. Tax cuts are going to really come through in early 2026. So that's a bit of a wash. I don't know that you need to have meaningful positive catalysts. I think things need to just be okay. And then those natural technicals will flow through and the markets will keep grinding higher. You feel silly making these arguments, but this is the reality of the market.
This is the exhaustion we were talking about in the previous hour. People are conditioned to buy, get out of the way. They'll keep buying.
And that's part of the reason why people are trying to come up with a rationale. Are things so much better now than they were before April 2nd? No. Why are people ignoring this? It's the way that it goes. And right now there's a lot of cash and people capitulated and they're coming back. I just wonder if there's a breaking point. And that, I think, would be the economy, to Evan's point.
Forgive me for getting back to the fundamentals. Let's talk about the economy and what the market's pricing. Inconsistent markets, apparently, according to Torsten Slock of Apollo this morning, who says the bond market continues to price the next Fed move to be a cut with the expectation that growth is slowing down. That's fixed income. Equities. The stock market is trading cyclicals higher relative to defensives with the expectation that growth is about to accelerate. Can you make sense of that for us?
Yeah, again, I think it's a sequencing thing, right? So part of the slowdown, the bending but not breaking of the economy that we expect is going to lead the Fed to cut rates. And I think that's going to ease financial conditions and support the economy into 2026, along with those tax cuts. And so as the market looks through, you see cyclicals start improving versus defensive.
That all sounds quite cute, doesn't it? Bond market's pricing in the slowdown that leads to rate cuts, and the market's responding to the rate cuts you might get because of the slowdown that the bond market's priced for.
Because people don't believe that the slowdown is going to be that significant and it's going to be a temporary thing that'll be offset with monetary policy. Yes, exactly.
We should start a podcast. This was great. Evan, thanks for dropping by. Evan Brown of UBS Asset Management. Torsten, if you're watching, there's the explanation. Apparently. Does that all make sense to you?
This is what a lot of people have been saying, that ultimately if there's a slowdown, it's not going to be a recession, and then you can get through it. The Fed's going to help get to the other side. And as we can see, the equity market's already in 2026, so 2025 doesn't really matter. It's a write-off, and if you get rate cuts, you're good. There is this question about what are we missing in the labor market, and I sound like Negative Nelly, but that is something that you have to watch about, as well as inflation. Can the Fed cut rates? If you have inflation that does pick up in any kind of way on the heels of tariffs, and this really does become an increasing issue heading into the fall.
It's on brand. Embrace it. Sounds
good.
good.
I feel terrible because people
Why?
come on and they're so positive and they're like, I'm like, yeah, but what about
got to offset
nuclear war,
That's what the news,
like,
that's what the news is for, Bramo.
It's morning, really?
Good morning. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Lizzie Burden. Hey, Lizzie.
Hey, John. Brazilian President Lula da Silva is joining South Africa in blasting President Trump for his threat to slap extra tariffs against BRICS nations. He's accusing the US of being irresponsible and called on world leaders to find ways to reduce international trade's reliance on the dollar. And President Trump says that he'll ship more weapons to Ukraine. Trump made the comments at a dinner with Israel Prime Minister Benjamin Netanyahu last night, just days after speaking to Ukraine's President Volodymyr Zelensky. The decision comes after the Pentagon halted flows of some air defense missiles and artillery shells to Ukraine. And travellers may get to keep their shoes on while going through standard airport security checkpoints. Sources telling us here at Bloomberg that the Transportation Security Administration is planning to update its policies to make the change. It's a move that would extend a benefit already available to individuals who pay for TSA pre-check. That's your Bloomberg brief. John.
Lizzie, thank you. What's wrong?
Oh, my gosh. Lisa doesn't have pre-check. I'm never traveling with you.
Literally, honestly, this is like, I feel bullied. I feel
do you
like...
have Clear?
You know,
do you have global entry?
No, I feel like Clear is actually...
It's now busier than the normal line.
I feel like it's a violation. I feel personally offended by Clear.
I have Clear and pre-check.
Hold up. Give her a chance. Why do you feel violated by this?
Because you've got to pay to play in this profound way. It's not just sort of a security thing. It's this idea of if you pay, you are shepherded in front of a long line of screaming babies.
Frustrates
and you just, it's just, I feel like it's unfair and it would be sort of hypocritical for me to
Some
join.
people watching this morning will think you're the smart one. Because if you go to the airport at the moment, on many an occasion, the normal line is the shorter line. TSA pre-check everyone seems to have now. Clear everyone seems to have
You gotta
now.
have both. Before I feel
Can you switch
self-righteous,
between?
all I could say, before I feel self-righteous, I waited for 45 minutes yesterday to get through
Did you?
security. So, but I didn't have to take my shoes
And
off.
you don't
so
have
yay.
so you don't have global entry.
I know. I mean,
So you don't have global entry.
I'm indefensible.
AMH, you are judgy this morning. Jeez. Up next on the programme, leaving the door open for trade talks.
The president will also sign an executive order delaying the July 9th deadline to August 1st. So the reciprocal tariff rate or these new rates that will be provided in this correspondence to these foreign leaders.
Up next, we'll catch up with Sarah Bianchi of Evercore, live from New York City this morning. You're watching Bloomberg TV. In case you missed it on Bloomberg Surveillance, in the commercial break, AMH just called Lisa ratchet. I have not heard that word. I have not had that word in forever.
Bougie ratchet, right? I just think of that song.
Wow.
It's just like you're wasting so much time. It's crazy to me that you don't have this.
I think I'll take the rest of the morning off and I'll go get it. So I'll see you later.
I'll come with you. All right. Equities so far, if you're just tuning in, good morning to you all and welcome to the programme. Futures positive by 0.1% on the S&P. On the Nasdaq 100, we're up by 0.25%. Under surveillance this morning, they're leaving the door open for trade talks.
The president will also sign an executive order delaying the July 9th deadline to August 1st. So the reciprocal tariff rate or these new rates that will be provided in this correspondence to these foreign leaders.
All of those, to understand you correctly, are now deferred to August 1st, right?
Correct. There will be additional letters in the coming days. He is literally looking at the map and looking at every country on the planet and seeing where they are ripping off the American people.
Here's the latest this morning. The White House unveiling a wave of letters sent to key trading partners threatening higher tariff rates, including a new 25% levy on goods from Japan and South Korea. Joining us now from the nation's capital is Tyler Kendall. Tyler, we couldn't achieve it in 90 days. What difference does an extra 3 weeks make?
Yeah, hey, John. Well, when we look at actually the tariff rates here, they're not marginally different, as you've been pointing out on the program. Japan, for example, is only up by 1 percentage point. Many of these countries are facing the same levels, the same sort of threats, like South Korea, also Indonesia, South Africa. I will point out, I think it's worth mentioning that some did see lower tariff rates, and perhaps that could boost their odds at getting a deal, such as Laos and Cambodia, which actually saw the biggest drop from 49 to to 36%. Essentially, though, we heard President Trump indicate that these are the countries that the U.S. at the moment are most frustrated with when it comes to trying to work towards a deal. And that's one difference between now and April 2nd when you look at which countries were prioritized for the letters. Japan and South Korea, our understanding has been, have long been prioritized in the talks to get a deal for a multitude of reasons. We've repeatedly heard from U.S. officials that these were the countries that came early and often to the negotiating table, not to mention the strategic components here when it comes to competition with China. At the end of the day, though, it does appear that this perhaps 3-week extension could be fluid going forward. President Trump said that August 1st was firm but not 100% firm, in his words, indicating that he's open to negotiations and that even these updated tariff rates could ultimately change at the end of the day. John, we are expecting more letters. You heard the White House press secretary there. Bloomberg Economics says that of the countries that have already received letters, they make up about 15% of U.S. imports.
Tyler Kendall with the latest. Tyler, thank you. More from Tyler later in the programme. So we've got some extra time. Joining us now to discuss, Sarah Bianchi of Evercore. Sarah, welcome back to the programme. How is the administration, the White House and trade partners going to use that extra 3 weeks?
Well, I think that you guys are right to say that what the White House is trying to do here is to signal countries where they are frustrated. Although South Korea and Japan early on were places where the White House was hopeful for a deal, they've really gotten stuck in the conversations around sectoral tariffs, or particularly around tariffs on autos, steel, some of the largest imports from those countries. The ASEAN countries, Cambodia, Indonesia, I think they're trying to follow more the model that we saw briefly outlined around Vietnam. So I think we're doing some signal sending. The administration has, I think, always been very, very optimistic about how many trade deals or even frameworks one can cut in a period of time. So I really just viewed yesterday this first set of letters as an indication of where, at this moment, the White House believes things are not on the path they want to see.
How powerful is the signal, though? And the president says it's firm, but not 100% firm.
Yeah, well, I think, there are certainly some in the markets who are just going to shrug this off because we have seen delays. We have seen this kind of high, tough talk before. I think what we would remind investors and other stakeholders is that right now, we do see the directional tariff rate in the next coming weeks going up. We're seeing countries like Vietnam ending up at higher than the sort of 10% baseline we've been at, and we have more sectoral tariffs. So some of this is just Trump negotiating that we've watched for a long time. But I think also we're at really high tariff rates right now. We're already at about 15%. And again, in our minds, the next signal points upward.
Sarah, do you have a decent understanding of what has been demanded by trade partners? Has the White House articulated that? Do they know what they need to do to get the tariff that's been put in a letter in the last 24 hours to get that tariff lower?
I think it really depends on the partner. I think certainly countries like Japan and Korea understand where the sticking points are, even though they don't like it. They just really, particularly, they've got their own politics. For example, in Korea, it's a very new government. Japan has an election coming up. They need relief on autos, really. So I think they understand. I think the bid ask is just at this part too far apart. Other countries, I know there is bandwidth challenges given how many countries are negotiating. So a country like Cambodia may be having trouble getting all the airtime they need to sort this out. I think it really depends on the partner. Interestingly, EU, that it's been traditionally very sticky, difficult trading partner for the Trump administration, they seem on track. So this is just kind of, a snapshot of where we are in this inning.
Sarah, what do we mean when we talk about getting deals? Because it seems like the details of these deals are actually very foggy, and it takes a long time. You've been intimately involved in crafting some of these deals. How realistic is it that they could be more than a framework anytime in the next few months, given just what goes into some of these negotiations?
Well, these are very, very high level, as you point out. For example, on Vietnam, one of the touted deals by the Trump administration, we haven't even really seen paper. And one of the big questions for Vietnam is they got a bifurcated tariff rate. They got 20% and then 40% on transshipment. Transshipment can mean lots of different things and can have lots of different implications. So these are extremely high level. And look, you have trade irritants with trading partners because there are sensitive political and economic issues, and they take a long time to work through. So the notion that we were ever going to get, 90 deals in 90 days was certainly thought of somebody who hasn't spent a lot of time negotiating trade.
Well, now it's 113 days, and I think a lot of people are questioning whether or not you can even get a dozen of deals done by then. When can we expect the sectoral tariffs to actually be announced?
Well, that's been interesting. Some of them are rumored to be coming any day now. Copper is supposedly close, lumber. I think the biggest ones that we're watching are on semis and the pharmaceutical industry. Those are very large sectors of the economy and very important from, particularly on semis, an inflationary perspective about where the administration goes. I think there's still a lot for the administration to sort out. But the way we have seen this president operate in sectoral tariffs so far is he comes out with 25%, pretty broad, and then negotiates from there. So far, they have been stickier in those negotiations. That's why the Koreas and Japans are so frustrated. But in terms of when he wants to throw this in the mix, sort of unclear, except I will say this president is feeling pretty good, coming off some impressive legislative wins and foreign policy wins. He may feel like right now is the time he has the bandwidth to put these forward.
So do you think he'll be more aggressive and let a lot of this drag on?
I think he is feeling bullish and more aggressive, and at the same time, the market, isn't necessarily always buying all of it. So that probably also tilts in the direction of wanting him to go even further. But again, of course, there's a lot of back and forth. I don't believe, for example, that Japan or Korea will end up ultimately with a 25% a reciprocal tariff. That's all part of the process. But directionally, again, we think we're on an upward move. And yeah, I do think he's feeling pretty good. And generally, that leads presidents to be a bit more bullish.
Sarah Bianchi of Evercore. Sarah, thank you. Certainly emboldened by all-time highs in the equity market more recently as well, perhaps. What do they say? Comparison is the thief of joy? It depends what you compare yourself to. And I think the market's comfortable with the idea that things will be worse maybe than the start of the year, but better than April 2nd. And so long as things are better than April 2nd, I think people can move on.
That was really deep. I love that. We just have to lower our expectations and then we'll be
Isn't
really
that what
happy.
we've done?
I mean, it's essentially the truth, though. We have to lower the expectations. Just don't make it that much worse. And then we're fine. I mean, 15%, the highest tariff rate since 1930s. It's okay. We can adapt and adjust, and that seems to be where the market's going.
Equities just off. Record highs on the S&P 500. Firmer this morning by 1/10%. Up next, the Daimler Truck North America CEO, John O'Leary, on the impact of tariffs on the industry. Plus, Yahara Anand with your morning movers. AMD shares rising on a price target hike from Citi. From New York, this is Bloomberg. Live from New York City this morning. Good morning. Snapping a two-day winning streak on the S&P 500 in yesterday's session. We pulled back from all-time highs, the biggest one-day loss going back to mid-June. Your bounce is pretty mild this morning, up 0.1% on the S&P 500. On the Nasdaq, up by around about a quarter. With 2 hours until the opening bell. 2 hours away from your cash open with your morning movers. Let's cross over to Yahara Anand. Hey, Yahara.
Hi, John. We have a few stocks moving off sell-side calls, and we start with AMD up about 1.5%. The chip maker rising after Citi raised their price target on the stock from $120 to $145. They are citing stronger than expected demand and signs that tariffs aren't hurting the chip industry. They say that across the board in the sector, they see solid demand driven by customers replenishing inventory. So good signs there. Next up, we have Bank of America. The Wall Street giant giant is falling 1.8% after HSBC downgraded it from a buy to a hold, citing limited upside ahead as these bank stocks have rallied nicely since their April low. We heard something similar last week from David George, who gave JPMorgan that rare downgrade due to the price. And this, of course, is coming as we kick off bank earnings next week. And we end with another financial stock, and that is Capital One. It is up about 0.9% after TD Cowen upgraded it to a buy, citing upside from the Discover deal, including being able to reach more customers globally. Plus, analysts there see the potential for major buybacks ahead. And as a result of all these tailwinds, they are also raising their price target to $258 on the stock. John?
Yahara, thank you. More from Yahara in the next hour. On our radar this morning, our top story, President Donald Trump delivering a wave of tariff letters yesterday informing countries of their new tariff rate. At the same time, Trump signing an executive order delaying the increased duties until August 1st.
So 113 days now is basically going to be how they can get these deals done. It was 90 days. Basically, when you look at these rates, though, coming out of these letters, the rates are the same. The dates are different. The question, of course, is can they get this done and how credible it is. Both of you have been bringing this up. How credible it is when the president's language is incredibly ambiguous and wishy-washy. Quote, I would say firm, but not 100% firm. If they call up and they say, we'd like to do something a different way, we're going to be open to that. But essentially, that's the way it is right now. So basically, everything is fluid and everything can change.
I didn't get a letter. Or do you think that there are trading partners that are kind of offended? You know, you didn't single me out. Well, I just wonder what we're going to end up seeing in terms of actual deals. If you didn't get a letter, does that mean that you get, a ticket to the prom?
Well, I think Bosnia and Herzegovina was potentially annoyed. There was a correction that had to be released in the letter because the president said Mr. President, but it was Madam President. So there were some individuals who got the letter and said, actually, I think this was directed at potentially the wrong leader of a country. And there was a correction yesterday
There's
as well.
some signal in that. This has been rushed. They need the extra time. A lot of people thought they'd need the extra time back on April 2nd and back after a week later when they announced the 90-day delay. And here we are. They need an extra 3 weeks.
Which, again, goes to the question of are they losing leverage and do they lose leverage by not just saying, look, this is a complicated procedure, we're going to have to kick the deadline, versus just say, we've got letters and this is going to be a serious negotiation because the market's not taking it very seriously.
It's some serious tension. You could see it in the economic data, at least. German exports sinking more than expected for the month of May. The value of shipments to the US plunging to the lowest level in over 3 years off the back of these tariff threats.
Yeah, so this is a real question about how much the European economy is going to suffer under the weight of some of these tariffs. We've been talking about European exceptionalism, about how there's this sort of renaissance in European equities, and this kind of challenges that a little bit, this idea that maybe they could take a hit. And frankly, this goes to the question of how much more can the euro strengthen on the heels of potential tariffs that could weaken the U.S. economy if we haven't accounted for the weakness in Europe on the heels of some of these levies.
Last week was fascinating. We had pushback from ECB officials. Off the back of the euro strength, and the euro stared it down and moved on and keeps grinding higher. I find that really interesting. The ECB's verbal intervention, and I think we can call it that, of the past week, has barely made a dent in the rally of the past several months.
They weren't scared by some of the ECB officials saying getting above 120 versus the dollar would make it complicated. And the market said, OK, make it complicated.
Let's keep it on Europe. President Trump saying he'll ship more weapons to Ukraine following talks with the President Volodymyr Zelensky last week. The move marking a reversal after the Pentagon halted flows of some weapons to the country in the past few months.
And the DOD followed up after the president's comments yesterday with a statement last night saying at the direction of the president, they're going to be sending additional defense weapons to Ukraine to ensure Ukrainians can defend themselves while they work to secure a lasting peace. The president's rhetoric is starting to get a lot hotter when it comes to Vladimir Putin than it is to President Zelensky. President Zelensky has talked about that their most recent phone call was the best one they've had since. And when it comes to Putin, Trump has said, I'm disappointed, frankly, that he hasn't stopped and he's not happy about it. And now he's sending weapons to Kyiv.
That's the latest on foreign policy. Here's the latest on trucking and the truck industry. Daimler Truck kicking off its Capital Market Day event today after lowering its sales and profit guidance for the year back in May, citing economic uncertainty in North America due to, guess what, drum roll, trade tensions. Daimler Truck North America CEO John O'Leary joins us now for more, alongside Bloomberg's Matt Miller. John, first of all, to you, sir, there was that downgrade to guidance back in May. I understand you've got an update for us this morning. How have sales been trending ever since?
Yeah, first off, thanks for the honor of being on your show. Yeah, I mean, it's definitely a lot of uncertainty out there right now. A lot of people waiting for the dust to settle. I think people are just looking for certainty, whether it's tariffs or any other economic policy. Our customers are kind of in wait and see mode because their end customers who generate freight moves and ultimately freight rates are also in wait and see mode. So everybody's just kind of on the sidelines, waiting for some sign of certainty.
And not buying trucks, it looks like you had a drop of 20% in unit sales in the second quarter. Is that, you think, likely to pick up now that we've got this big, beautiful bill and we're starting to see trade deals go out? Or do you expect continued uncertainty to hold back revenue in Q3?
Well, I think there's a lot of interpretation of the big, beautiful bill that needs to happen. And ultimately, like I said, end users who generate freight, they need to figure out if it's good for them in their particular industry. Obviously, our customers are hauling everything from steel to groceries to petroleum to everything. So how the bill impacts each one of those end markets ultimately drives, a segment of our orders. So we'll have to see how that all shakes out. Still, I would say a lot to remaining to be seen, and it's all not just the big beautiful bill. Also, there's economic policy, and you've been talking about tariffs and other things out there. So there really needs to be, I think, a firming up of economic policy before people understand or realize this is what we have to work forward with, and then we can all adjust and move. But in the meantime, there's the uncertainty just has people frozen.
You have, I don't think a lot of people realize, I think you make more school buses than anybody else in this country. You have a ton of production, obviously, in the United States of America, but also a couple of plants in Mexico. How agile is your supply chain? How easily can you move, Freightliner production back to U.S. plants, or up the count of U.S.-made parts in your Mexican-produced trucks?
Yeah, that's a great observation. And we are the nation's largest school bus producer as well. Thomas Built School Buses, which is located about 30 minutes east of where I am right now. We have a number of plants in the U.S. This Cleveland truck plant is our largest heavy-duty truck plant. About an hour north of Charlotte, we have another medium-duty truck plant just west of the Charlotte airport. We've got a parts plant in Gastonia, also by the airport. We've got a custom chassis division located down in Gaffney, South Carolina, just over the border. So we're hugely located center gravity-wise in the Carolinas. But then, as you said, we also have a couple of plants in Mexico. So we're flexible. We can build any of our models in either country. We've really tried to, be as flexible as possible. And certainly, if we ever got into a peak market, we might have to look at expanding some capacity in the U.S. to be able to accommodate that. But certainly today, at the market levels we're at, to move it back and forth is really not so problematic. You also alluded to the supply chain, and that's probably the bigger issue because, a lot of those folks, it's been well documented, the integrated nature of automotive, and we are obviously not cars, but we're part of the automotive industry writ large. There's a huge amount of integration between Canada, Mexico, U.S. in the supply chain, and that takes a lot longer to be able to, to adapt. There's just not too many empty plants sitting around in the U.S. That are currently, up to date with tooling and a workforce, parked outside waiting to go to work. All that stuff takes time. And typically to bring a new plant online or even to refurbish an old one and get it up to today's standards, you're talking 3 years potentially. So it's not an easy problem to solve.
John, in terms of the tariff that gets slapped on your trucks assembled in Mexico that come back here for sale in the U.S. market, the 25% only applies to the non-U.S. produced parts, right? So if you have a truck that's made of 40% non-U.S. sourced parts, that's only like a 10% hit. How much of that can you eat? Because you have pretty fat margins, right? 14, 15% in the trucks business. How much of that tariff can you eat, and how much do you have to pass on in price increases to your customers?
Yeah, so today, obviously, we're USMCA compliant, under the existing regulations. And obviously, there was some discussion still underway by the administration to reopen USMCA. Today, that requires roughly 65% U.S. content, which for our Mexican trucks, we're able to definitely, bring into line with the powertrain whether it's engine transmissions, axles that we ship into Mexico for installation, then ultimately get credited back when they come across the border for some inside baseball. But yeah, you're correct. I mean, there's definitely some inflationary pressure that comes with any kind of tariff. And what that ultimately shakes out to is going to be the nature of what the tariff is. So there's also a competitive landscape to consider as well. Obviously, I think every manufacturer would love to push every dollar of tariff out as fully into the economy as possible, but you've got competitive pressures as well, and we're in a pretty competitive industry. We have some great competitors that we fight tooth and nail with. So how much ability we have to ultimately do that remains to be seen.
I want to come full circle because this really does bring us back to the answer to John's initial question. When you said we're ultimately in wait-and-see mode, we've been trying to quantify what that uncertainty looks like for someone in the C-suite like yourself. What does that mean? Does that mean you're not making certain investments, that you're not making certain hires? Is that the reason why you're buying back stock rather than necessarily investing, say, in autonomous driving capabilities?
So, I mean, we've always felt since we became a separate company in 2021, we've been very bullish on stock buybacks, and we've continued to do that. So that's not a new thing, a new decision that we've made, you know, in reaction to anything else that's going on. That's an independent decision, and we clearly want to make sure that even as we do that, we have other money to pay dividends with and other money to make investments with. So we've obviously thought that through, and we feel like we're fine in any situation there. But yeah, in terms of investments, those typically are more driven by environmental regulations. And there's a lot of change going on there. We haven't talked about that, but there's clearly a lot of change going on. Obviously, the EPA has rolled some things back. California has rolled some things back. And ultimately, that drives a lot of our major investments, because when you talk about bringing engine or ultimately the entire powertrain up to speed in terms of more fuel efficient or lower CO2 or whatever the regulations are, there's a big cost that's associated with that.
Hey, John, I know you've got a busy morning. Thanks for making time for us. Appreciate it. John O'Leary there, the Daimler Truck North America CEO. Thank you, sir. Matt Miller, thank you.
My pleasure.
It's good to see you.
It's great to be here.
Thanks for dropping by and waking up early. Thank you very much.
I mean, normally I'm sitting in the control room watching your show.
For the benefit of the audience, you keep going with that. Matt, appreciate it. Look out for Matt Miller again at 9 a.m. Eastern Time as we work our way towards the opening bell. Let's give an update on stories elsewhere this morning with your Bloomberg brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. President Trump says that he's going to travel to Texas on Friday to see the devastation from flash floods, which killed at least 100 people and left dozens still missing. The deaths include at least 27 children and staff from a summer camp. Recovery teams expect to find more victims as a search continues. And elsewhere, Porsche shares are higher after the car maker reported a slowing decline in first half sales. Deliveries came in at 6% lower in the first half from a year ago, with fierce competition in China leading to a 28% sales slump in the country. Growth in North America slowed to 10% after an initial 37% surge in the first 3 months of the year. And in sports, the Wimbledon quarterfinals get underway this morning with Taylor Fritz and Carlos Alcaraz both set to play. Top-ranked Yannick Sinner will play tomorrow after surviving an upset scare against Grigor Dimitrov, who had to retire due to injury during a 2-set lead. In the women's tournament, number 1 ranked Arina Sabalenka will play centre court later this morning. And that's the Bloomberg Brief. John.
Lizzie, thank you. Heartbreaking for Dimitrov yesterday. Just brutal to see him 2 sets up against the world number 1 and then have to retire. Matt, before you go, just one final word. The 9/11. What happened?
Yeah, we saw a huge dip in 9/11 sales in the first half, so Porsche broke out sales globally. But here in the U.S., they sold a lot more Macans, the lowest priced vehicle that they make, and a lot fewer, like 1,000 fewer 911s.
What's that telling you?
It means that the prices have risen so much that U.S. consumers are really starting to pull back.
Where's your 911?
I've been in that 911.
I went in that too.
I love that car.
It's a nice car back in the day.
It's a very well-made car. It's over-engineered, which is why people love it. But it's really expensive, and the price continues to rise higher and higher, obviously, with this tariff.
Who's got your old 911 now? Where is that?
It's in Berlin.
It's in Berlin?
Yeah.
Okay. So
doing the speeds it deserves.
The happy owner of Matt's old car. I hope you're enjoying that, Matt. Thanks again. Up next on the programme, Crossing a Line.
This is a time now for Musk. He needs to choose. I think there's a line in the sand, that he's now starting to cross. I believe you've now hit a point. I think the board's going to have to get involved.
We'll ask that question to the ARK Invest CEO, Cathie Wood, who joins us next. Live from New York, this is Bloomberg. Stocks are positive here by 0.1% on the S&P, up by 0.3 on the Nasdaq 100. Under surveillance this morning, crossing a line.
This is a time now for Musk. He needs to choose, and you can't keep having these one step forward, two steps back. I think there's a line in the sand that he's now starting to cross. I believe you've now hit a point. I think the board's going to have to get involved.
So here's the latest this morning. Tesla shedding nearly $69 billion of its market cap after the CEO Elon Musk unveiled his bid to start a new political party, marking the biggest percent drop since initial falling out with President Trump only last month. Joining us now to discuss is Bloomberg's David Welch. David, welcome to the program, sir. Operationally, this is something we keep going back to. Do you see the damage being done to brand Tesla because of the CEO's political ambitions?
It certainly is. You look at research about who buys electric vehicles, it tends to be people who are politically left of center or very left of center. Republicans, you tend to be just less interested in buying them. So when you align yourself with Trump, that hurts. And then he's got his own political party. He's got some views that are not popular with certain people. Look, there's a reason that other CEOs like Mary Barra of General Motors don't really say much about politics. They stay very neutral. They play along with Trump because they need to work within his policies, but they just don't get involved publicly and make big statements because they want to sell a car to anybody. And I think that really has hurt Tesla. And it's clearly upsetting shareholders too that Elon keeps sticking his nose into politics, and he sort of wants to live there and not live in the Tesla headquarters, keeping the company running.
It certainly hurt shareholders yesterday. David Welch there of Bloomberg over in Detroit. Not so much this morning, bouncing back by just 1% in the pre-market. Joining us now, one of the biggest bulls on this stock for quite a while on the street, ARK Invest CEO Cathie Wood. Cathie, thanks for making time for us this morning. Let's just talk about what Dan Ives said to us yesterday, that he believes Elon Musk is crossing a line and that the board needs to step in. Do you share that view?
Well, I have to tell you, we've been dealing with controversy around Elon Musk in one form or another since we first bought the stock when the company was founded in 2014. And we own Tesla it's one of the top holdings in 3 of our ETFs, so ARKK, W, and Q. So we are watching this like a hawk, no question about it. But with the experience over the last 11 years, we turn around today and see Tesla really not an EV manufacturer anymore, moving into the robotaxi age, we believe successfully, and we believe it will scale much better than most of its competitors. We see SpaceX really owning 90% of all of the satellites out there, Neuralink transforming lives of paralyzed people, people with ALS. And probably most surprising of all, XAI. Now, we own all of those, again, in our venture fund, following them very carefully. XAI is, on some benchmarks, it hit a point that O3 Pro hit in June. It hit it in February. So, we are very focused on barriers to entry, technology, moats. And we believe that the moats that Elon has built, and obviously this is not just Elon, he's attracting the best and the brightest to help solve some of the world's biggest problems. So again, we do trust the board and the board's instincts here. And we stay out of politics.
Well, we'd love your opinion on the current situation, just on Tesla specifically. You mentioned some phenomenal companies doing some incredible things. For Tesla, though, do you believe that Elon can pursue his political ambitions at the same time pursuing the best interest of Tesla shareholders?
One of the announcements Elon made recently is that he is going to oversee sales in the U.S. and in Europe. And when he puts his mind on something, he usually gets the job done. So I think he's much less distracted now than he was, let's say, in the White House 24/7.
At what point do you see sort of the political landscape shifting, though, not just for Tesla, but for the haves and the have-nots in some of the big tech space? I know you've had a complicated relationship, say, with Apple, which seems uniquely pegged by some of these tariffs. Is there anything that you could see that would make you like that stock again, or do you think that really it is going to fall out of the Magnificent Seven?
Yes, we've been watching Apple for a long time with an AI lens. And that started, I'm going to say, about 7 years ago when it was becoming serious about autonomous vehicles. If you think about the ultimate mobile device, it's an autonomous vehicle, and that should have been Apple's to win. And what we've seen there is one turnover of management teams after another. And it's all, autonomous driving is an AI project. It's the largest AI project on Earth, we believe. And so losing the talent that it has, and as I understand, it lost another one today to Mark Zuckerberg's top 50. So they've had a lot of trouble in this regard, and I think the burden of proof is on them.
Do you think that it is time to follow the talent, that this is going to work, the gamble that you're seeing over at Meta, and that that's the path of travel for the other big tech companies that are going to just eat some of the companies from the inside out, take the talent, not necessarily buy the company?
You know, it's a very good question. We're trying to figure out if what Mark Zuckerberg is doing today is much like he did when he was pivoting hard to the metaverse. Which proved, because he thought that was the next big thing, and that was incorrect. AI is the next big thing, no question about it, and you do have to have the right DNA, and you have to move fast and break things, as he would say. So, you know, it'll be interesting to see if he's able to turn his open source strategy, and we've admired that quite a bit in terms of generative AI, into a leader again, or as we were observing it, Apple's Llama 3 at the time was improving at a faster rate than some of OpenAI's models. And that was true of open source generally. And then that has stopped. So yes, he had to do something. Is this the right thing? Why did that stop? I don't know.
Cathie, next time you're with us, we'll have a longer conversation. Two leaders, incredible men, doing incredible things. ARK Invest CEO, Cathie Wood from New York. This is Bloomberg.
The administration is looking for that last bit of pressure to get these deals where they want them to be.
This is a perpetual negotiation that we'll continue to see unfold.
This is President Trump at his best, bringing the pressure and supporting his negotiators.
The market is trying to operate like this is going to be a nothing burger, but we are seeing tariff rates go up.
As the days and weeks accumulate, we're going to get greater certainty around what the trade policy posture is going to be.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
This was the week. This was it. July 9th. That was the day you would get additional clarity on trade. You're not getting it. Live from New York City this morning. Good morning. The third hour of Bloomberg Surveillance starts right now with equity futures on the S&P slightly firmer, just a touch positive, up by 0.1%. A bounce back on the Nasdaq of 0.2%. Your week ahead still includes jobless claims coming up in a few days. It still includes earnings from Delta Airlines. What it won't include is clarity on July 9th on the path forward for trade.
Because ultimately that can's been kicked and people are watching that and they're saying, okay, so August 1st is the new July 9th. Maybe. Have we gotten any certainty? And I think that's a valid question. Is there a certainty in the uncertainty? The fact that there is some sort of prolonging in the deadline at a time when companies are figuring that the cap is not 145%, maybe it's 25%, maybe it's something like that. And that, I think, is what people are trying to figure out at this point.
Most people think the temperature was taken down after Liberation Day. If you look at some of the letters that went out yesterday, it does look like another maximalist approach, escalate to de-escalate, because essentially the rates are the same, but Trump's giving them 3 more weeks to come to the table. I'm still waiting on what happens with countries like India, like the European Union, like Switzerland, where we know that there have been tons of negotiations at the table and a lot of talks. Potentially this week, we get actual frameworks and agreements with some of those countries.
Investors want to make it really simple. July 9th was meant to be a clearing event. It's not going to be anymore. For the Federal Reserve, they were going to wait to get 2 months of data, maybe sit there in September and reduce interest rates. When they get together at the end of July, they still won't know what the tariffs are going to be a day later.
Is certainty overrated? I mean, I'm asking this question genuinely because we've been saying, we just need certainty and then we can keep flying and then people can keep, figuring out their plans and stocks can keep going up and businesses can keep going and the economy will be just fine. And we don't get the certainty and people are saying stocks can keep going up and the economy is going to be just fine. So what gives with that? Is it basically the uncertainty is something we can live with if there's a band that it sort of ranges within?
With Trump, the only thing certain is it's going to be bumpy and it's going to be uncertain. But this from the National Foreign Trade Council represents large U.S. firms, saying the strategic uncertainty is producing some short-term results, but continuing to threaten exorbitant tariff rates is just paralyzing for the business decision-making and erodes trust with their allies and major trading partners. So at some point, the businesses are still potentially holding off on massive decisions until they get the final results.
Inflation hasn't spiked. The economy hasn't collapsed. Is that sufficient to sit here and say that things are okay? I don't know, but for the time being, things seem to be okay.
July 15th, or later this week when we get Delta earnings, we'll see how okay it is and what pockets are falling out or not, what pockets are accelerating. It was not that long ago when inflation was a good thing for companies. If we do get inflation, can they pass that along? I mean, we're talking about Porsche having lower sales. Is that really the clientele that's going to be worried about some sort of price increase, or is it a product mix issue? I keep going back to this with particularly
the Porsche 911, the economics of the Porsche 911.
Okay, so people are really out there saying, well, I don't know, an extra couple
Cut rates
thousand.
right now, chairman pays up early, emergency meeting.
I don't think I could go from 120,000 to 121,000.
Not sure that moves the dial for them.
Correct.
For the July meeting, anyway.
Oh.
Might move the dial in September, Bramo. You never know.
Yeah.
Might be really freaked out about that.
Oh, no, the Porsche prices.
Futures this morning, positive by not even 0.1% on the S&P. Busy 60 minutes coming up. Alex Altmann of Barclays as markets keep climbing a wall of worry. Stacy Rasgon of Bernstein on tariff whiplash in the chip sector. And Amanda Lynam of BlackRock on the risks of being too defensive. We begin this hour with stocks pushing higher as President Donald Trump signals a willingness to continue trade negotiations. Alex Altmann of Barclays writing, the backdrop for risk assets is as benign today as it has been all year. There remains room for stocks to grind higher into month end. Alex joins us now for more. Alex, good morning.
Good morning.
What's the price of the continued uncertainty here?
So I think the price of continued uncertainty is that we're going to end up with essentially an environment where Lisa pretty much covered it. If we're just going to have a period where companies can't make decisions anymore, and consumers are going to hold off their spending decisions, at some point that is going to bite. And we talked about this a while ago, if you remember. We may be past the sort of peak uncertainty. We're probably not past the peak negativity. And I think we've just got to sort of take stock of the fact that at the end of the day, tariffs is another word for taxes. There is a tax that is coming towards the economy. And whether we split that between the corporate or the consumer is kind of irrelevant at this point. We're going to have that tax that will get hit in H2.
The way you explain it implies the worst of the data is still in front of us and not behind us. But what we've heard from many equity investors so far this morning and the past week is they're OK with that because the Fed's going to cut interest rates and it's going to be better in 2026. Do you take a different view?
I would take a slightly more balanced view. I think really my view stems and starts at two things. One is positioning. So from a positioning perspective, we talked about this before. I think that's a lot of the reason why stocks have got to where they are. The problem is now stocks are where they are, and we're back at trading at sort of 22 times. If we start taking an optimistic view on 2026 earnings, we're trading on around about 20, 21 times. So stocks are not particularly cheap as a starting point, and that at the end of the day is going to create a bit of a headwind in terms of what the path forward is for risk assets. Risk assets, the members thinking, oh, everything's fine because nothing's actually hit the economy yet. Of course it hasn't, because we've been in this purgatory period. So we have to work off an assumption that there will be a tariff hit in the second half of the year, and it will either hit the consumer or it's going to hit corporates, or potentially a little bit of both.
You're the most bearish, bullish person I've ever met in my entire life. You're making an argument, and I'd say, okay, so you're selling stock. No, I'm buying them, because I think they're going to continue going up. So can you square that circle, please?
Yeah, sure. So look, we came into the quote that Jonathan just gave just now was basically us at the beginning of June, which was we were bullish, and we to a degree still are, largely as a foundation of AI CapEx, this fiscal tailwind from the OBBB, which is going to be about 40 to 50 basis points. And then positioning. I think you've really got to put positioning front and center as part of your investment process right now. Because when investors were so disconnected in terms of their positioning to the market, vis-a-vis where the S&P was trading, we knew that there was a systematic bid that was going to actually drive risk higher. That's still happening today, and actually that's underpinning a lot of our bullishness right now. But fundamentally, it's becoming more difficult to get extremely bullish on the index at these levels. So what we've actually decided to do at this point is start to look a little bit more rotationary under the surface. And primarily, that's looking at something like within the small cap space. So we're actually turning quite constructive on small caps here, and that's driven by the OBB primarily, simply because it's getting a disproportionate benefit to smaller companies at this juncture as a function of the depreciation and amortization and also the interest deductibility. You put those together, and actually that provides a significant tailwind to smaller companies within the market. So that's where we're actually quite constructive right now.
Incredibly counterintuitive if you expect the economy to roll over, to be constructive on small caps. But I get your point about the OBBB and how that could potentially be stimulative. If it's stimulative, how does the Fed cut rates at a time when potentially inflation is going up? Potentially you get some sort of fiscal boost from the one big beautiful bill. And the economy isn't rolling over yet. So there is this idea that you could get this absorption of some of the price increases by the consumer.
I'm not sure about whether the consumer can absorb any more price increases. I mean, do you really want to see your coffee go from $7 here in Manhattan to $8 tomorrow? You know,
I get free coffee.
Fine. Okay, well...
Carry on.
Convo killer, Abramowicz. Let the man speak.
About your matcha.
All right, move on. Sorry
Alex, we
about
fully
that.
understood where you were going. Continue, please.
So someone's going to have to absorb it somewhere. Even if you're getting your free coffee, someone's paying for the coffee. So and so therefore, is it actually the corporate instead? Anyway, the point I'm trying to make is that I think there is an absorption capacity within the economy. We could talk about a slowdown that's not a recession. We could talk about interest rate cuts by the Fed, but we're talking maybe 25, 50 basis points. Is this really going to move the needle off where the base level is right now? And I don't think it's material. So when I think about things like small caps and why I'm constructive on them, that's really driven, again, by the positioning argument. And I really want to hit home on this because positioning is ultimately what's driven a lot of the market higher over the past couple of months. It's been positioning and it's been earnings upgrades that's largely been driven by the FX component as well. And I think that positioning dynamic is now going to start percolating into other parts of risk.
Alex, I'd love to ask you about what you're talking about, the fiscal tailwind for the one big beautiful bill. Won't that just fade when the economy's confronted with the tariff rates? Don't they cancel each other out?
I think they do eventually. And I think essentially what we're trying to do, Annmarie, is trade the sequencing. And I think that's really important. If you take the S&P in 2025, we're up, 4, 5, 6% or so, that clearly is not telling the picture of what's happened over the course of this year in the first half. And so every month has really been a story in its own way. And I think all we're trying to do is continue that story. Each chapter is about 1 month long at the moment.
Someone else mentioned this. It's about the sequencing. What's next, then, when it comes to policy in Washington?
Well, I still think we're going to get clarity, or hopefully some clarity, on August 1st in terms of those tariffs. But I think what's important is that yesterday, as a case in point, you had a bit of negativity that the letters got sent, but we've still got 3 weeks where we can get deals done. And I think people are forgetting, again, the sequencing there. What is the probability that we're going to get announcements from Switzerland or Europe or whoever it may be? That's going to be positive incrementally for risk. So I think that's an important point.
But there's one cloud, and it's China. Isn't that going to be months and years in the entire Trump administration as they try to get a grand bargain?
Most likely, and I think it's interesting that the rare earth deal was only set for a few months, as an example. So yes, we are going to have this issue down the line. I will just highlight one point, though, in terms of the uncertainty and Trump providing the bumpy ride, as you call it. I think it's important to clarify that between 2017 and 2021, i.e. when Trump was actually in office, he actually oversaw a lower period of the VIX than average going back to 1990. And that includes COVID. If you take out the actual COVID months, so basically Q1 and Q2 of 2020, it's dramatic. We're talking 4 or 5 points lower on average in the VIX. So even though Trump may talk a bumpy ride, actually his track record is a lot less volatile than you think.
When did that vol trade blow up? Early 2018?
That was February 2018, yeah.
Did that have anything to do with policy?
No, it had nothing to do with a load of short VIX positioning.
I remember all of that. That feels like a lifetime ago, doesn't it?
Yes, and people still talk about it today because they'll think about there's a lot of like short vol strategies in the market again, but they're different kind of short vol. It's not selling puts, so to speak. It's selling calls, which is a very different prospect in terms of the impact it can have on the market.
Good to see you, sir.
Nice to see you.
Grab a coffee on the way out.
I will. It's free.
Right, good. Alex Altmann of Barclays. I'm told it's really good. Appreciate your time, as always. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Joining us now, Lizzie Burden. Hey, Lizzie.
Hey, John. President Trump has delayed imposing higher tariffs on US imports until August 1st, while sending letters to countries detailing the levies they'll face. The letters include 25% tariffs on goods from Japan and South Korea and plans for more than a dozen other countries. The president also teased the possibility of further talks ahead of the new deadline. And more than 100 people have been confirmed dead in floods that tore through central Texas over the weekend. Local, state and federal officials have faced criticism in the aftermath of the tragedy. Senator Ted Cruz downplayed concerns that President Trump's cuts to the National Weather Service played a role in the failure to evacuate people. And here's one for you, Annmarie. The New York Knicks have announced their next head coach. Two-time NBA Coach of the Year Mike Brown is going to be taking over the team coming off its first conference finals appearance in 25 years. Brown is coming from a successful 3-year run in Sacramento that saw the league's longest ever playoff drought come to an end. And that should be my brief, John.
Lizzie, thank you. More from Lizzie in about 30 minutes' time. Up next on the programme, the morning calls, plus Stacy Rasgon of Bernstein on tariff whiplash in the chip sector. Live from New York this morning. Good morning. You're still judging Bramo.
No coffee, no TSA pre-check.
Listen, we all have our things.
Everyone's got their things.
Exactly.
I'm sticking up for you today.
Thank you. I appreciate that.
Pretty
I've got a
brutal
lot of
stuff coming
things.
from the other side of the desk.
Yeah, you would go travel with her without TSA pre-check or global entry
I would just
coming
go
in
through
from
on my own. Global entry and let
story.
you know.
Really,
We
you're
have done
sticking
that.
with her then.
I think we've done that.
I'll see you later. I'll see you at the
See you
lounge.
later, Bramo. Done that before. I'll do it again. Equity futures on the S&P, positive by 0.1%. On the Nasdaq, up by 1/3. That's the price section. Let's get you some morning calls. First up, Wells Fargo raising its price target on Amazon to $238, saying it's the best setup of the mega cap internet stocks for the second quarter earnings. That stock is up by 1/3%. Your second call from TD Cowen, upgrading Capital One to buy, seeing upside following its purchase of Discover. The stock is up by 0.9%. And finally, KeyBank raising its price target on shares of onsemi to 65, saying tariff-related pull-ins are driving near-term upside. The stock is up by more than 2%. Let's stick with the chip makers. The sector facing potential headwinds after President Trump unveiled 25% tariffs on both Japan and South Korea. Samsung's profit falling for the first time since 23, with the company pointing to US chip curbs weighing on results. Joining us around the table, Mandeep Singh of Bloomberg Intelligence. Mandeep, good morning.
Morning.
How difficult are things getting for this industry?
Well, right now we are seeing two pockets. One where things are really booming on the AI data center side, and the other is where tariffs will weigh in terms of the pricing for some of these devices, whether it's an Apple iPhone or a Samsung device. So clearly there is that factor, but there is no doubt that the AI data center wave is what's driving the bulk of the demand and the investments. And that continues to be very strong, irrespective of the tariffs.
How do you factor in the impact of tariffs when you don't know the tariff rate or you don't know the date the tariff rate will take effect?
Well, so a lot of the speculative pull forward, I think, is driven by the uncertainty, and that's been playing out over the last 3 months. So for companies that are looking for more gear that they have to get from China or the countries that may end up paying much higher tariffs, they have been front-loading a lot of this stuff. And I'm sure it's going to keep going until there is certainty, because there is a lot of back and forth when it comes to the tariffs.
Is the uncertainty more about the tariffs when it comes to the semis, or is this really about the potential restrictions and what those are actually going to ultimately look like at a time when we've seen a rollback of some of the initial constraints put on China with respect to semiconductor manufacturing equipment, et cetera? Isn't that the bigger issue?
Well, so when I look at the China exposure for a company like NVIDIA or any of the other chip makers, it has somewhat de-risked, at least for this year. anything that ends up happening in terms of a deal will be positive news for these companies to be able to sell to China. With that being said, there is always that aspect that what if China really decouples in terms of their chip dependency and, use their own Huawei chips or something else? And what does it do for the market long term? In the case of NVIDIA, it's a 20% revenue exposure. So you completely take out that forever. So that's what I think the administration doesn't want, which is why they backed off from the diffusion rule. And I do think they want the US-based companies to be able to sell to China, because at the end of the day, it is revenue for NVIDIA or AMD or all these chip makers.
Here's a quote for you this morning. Our necks hurts. Liberation Day, on again, off again tariffs, export controls, rates skyrocketing, increases in global conflicts, you name it. When a car rolls over that many times, it's natural to have some whiplash as a result. Joining us now, Stacy Rasgon of Bernstein. Stacy, that was your quote. You also said sleep through the accident, walk away unscathed. Stacy, can we walk away from all of this unscathed in the sector that you cover?
I don't know. The reason we said that is it was just sort of funny when I wrote that note, which was a couple of weeks ago. Given all the volatility and everything that happened, if you'd just gone to sleep on January 1st, you would have been fine. Right? That's kind of what I meant by it. And it's been really amazing to me, amid all of the volatility and everything that's going on, like if you just look at the endpoints, how stable things have actually been. And we'll see if that continues. Again, I don't know. It looks like the news flow and the volatility is starting to pick up again, as you mentioned earlier.
But what you're basically saying is that a lot of these rates can be negotiated away. But at the same time, Stacy, a lot of them can also stick. What happens if they do stick?
Yeah, you bet. So, we got these tariff letters yesterday. Again, it was on Korea and Japan and Thailand and Malaysia and a bunch of other companies. To be fair, most of those rates are effectively what the reciprocal rates were anyways, plus or minus, right? And we're all waiting to see if the reciprocal rates actually get put back on August 1st. So this does sort of feel like a last hammer, to try to maybe get a deal before that deadline happens. So we'll see what happens. I don't know if these rates actually go into play. I don't know how long they stick if they go into play. I don't know if there's any changes. Like we'll have to see what happens. In terms of the actual risk, you asked the question earlier, how do you size this stuff if you don't know what it is? It's very difficult, right? And it's sort of even more complex for semis because most semiconductors don't enter the U.S., by themselves. They enter inside other things like smartphones and PCs and cars and what have you. And so most of the tariff impact that we've been looking at so far has been indirect. It's the end products maybe get more expensive and there's elasticity of demand. And so you have less demand for those and therefore you may have less demand for semiconductors. And to be fair, it's hard to size. And in the near term, I think I heard earlier, like you're talking about, we've been actually seeing some pull forward, which makes sense given all that uncertainty. Now, there is one area for direct impact that I think we are waiting for, and this is the sectoral tariffs, the 232 investigation that the Commerce Department put on April 1st. And that may directly impact semiconductors. And the comment period's over. We're waiting for a decision. My suspicion is that those will get put on at some point. And the impact sort of depends, right? I mean, if it's a 25% tariff on semis, that kind of sucks, but we could probably deal with it. Like semiconductor ASPs broadly are up 50% over the last 4 or 5 years anyways. If it was 100% tariff, then like that's a whole other ballgame. Like, and I don't know what that's going to look like until we actually find out. And so that is sort of a headline out there, or a headline risk that I think we're waiting for in the space now.
What's the tariff rate that would actually torpedo the AI trade right now?
Well, it's interesting. So the AI trade, like the AI servers, the way that the tariff structure is currently set, they're actually not as exposed because it turns out most of the AI servers that come into the U.S. come in through Mexico. And they're USMCA compliant. There's no tariffs on them at all. And so to the extent that those supply chains can run through Mexico, that actually preserves things. I also think there is one advantage with the AI is that the demand is actually off the charts. And whereas, for a smartphone, all of a sudden, if your iPhone cost doubles, they may sell less of them. If the pricing of AI servers were to go up 20% or whatever, my suspicion is they would still get bought. And so there's a natural, push of demand on the AI side that I think is helping a lot. And then you have this other avenue through the USMCA, that's the US-Mexico-Canada agreement, free trade agreement, that helps to at least somewhat insulate them, at least relative to other spaces that have the potential to be hit more by tariffs if the tariffs actually get put into place.
Stacy, you mentioned smartphones. Can we just finish on that? What it means for Qualcomm, a lack of demand there? Just what is priced at the moment from your standpoint?
Well, so Qualcomm's very, very cheap, right? And I mean, it's people are worried. We know Apple's going away, and like there's headwinds, and there's no catalyst from that. Now that being said, in my opinion, it's you could argue like even with ex Apple, I think they're growing EPS double digits, and it's like 14 or 15 times earnings ex Apple. But if people are waiting for a catalyst, there isn't much for now. But I actually think it's sort of an interesting. It's a good time at least to sort of like sharpen your pencils. 2027 and beyond, when the Apple revenue gets small, it starts to look interesting. So it's 18 months away. In terms of the smartphone demand, and again around tariffs, the U.S. Imports about 10% of the world's smartphones. Half of those are iPhones, and more than half of those are iPhones. So it's really not so much that we import a lot of smartphones. We import a lot of iPhones. And again, Apple started to design their own chips. It's that revenue is going away from Qualcomm. We already know that. And so the extent that like tariff, higher prices and everything might impact smartphone demand in the U.S., to the extent that it's insulated or isolated more to the Apple side of the equation than the Android, it's actually less fundamentally impactful for Qualcomm over the long term because that business is going away anyways.
Smart. Stacey, appreciate your time. Thanks for making time for us. Enjoyed the note as well in the past few weeks. Stacey Rasgon there of Bernstein with the latest on that business. Mentioned Apple at the end there. Mandeep, just quickly, this war for talent. Meta going after Apple. What was your reaction to that story?
Well, Meta right now has the compute, they have the researchers, and they are spending big. When it comes to Apple, they haven't even started investing in their own data centers. So I'm not surprised they're losing talent, because if you're an AI researcher, Meta or OpenAI or Anthropic are the companies you want to work at because they are investing big. They have Apple still has the distribution, but they have clearly underinvested, so I'm not surprised they're losing talent.
And Zuckerberg comes along writing checks with a lot of zeros, apparently.
Tens of millions of dollars, and that's what you think that college interns should aspire to.
Real money.
Oh, yeah.
Yeah. Up next on the programme, Michael Reid of RBC Capital Markets on the future for rate cards, plus Yahara Anand with your morning movers, taking a look at a downgrade on an incoming member of the S&P 500. Stocks are positive by 0.1%. The open about 60 minutes away. Just yesterday, snapping a two-day winning streak on the S&P, pulling back from all-time highs with the biggest move lower since mid-June. But based on what we saw at the start of April, this is nothing as we delay the trade decision from April 9th, or rather April 9th on a 90-day pause, to July 9th, from July 9th now to, where are we, August 1st. Am I up to speed? Just about.
Maybe. Are we up to speed ever? August 1st? Can August 1st become September 4th? And that really is going to be the key question. And then what do we have? A policy of uncertainty.
And a Federal Reserve that is stuck between a rock and a hard place and isn't cutting interest rates anytime soon, unless this labour market starts to crack. More data on the labour market later this week. With 60 minutes until that cash open, let's get you some morning movers. We can do that with Yahara Anand. Hey, Yahara.
Hi, John. We start with Datadog, which, as you said, is joining the S&P. But today, it is lower 2.6% on a downgrade. Guggenheim slapped it with a rare sell rating. And the reason has to do with OpenAI, which is Datadog's biggest customer. Guggenheim says that OpenAI may be ditching its tools, opting instead for an in-house system, and they say that could cut into revenue in the second half for this company. Next up, we have shares of Circle Internet. They are down 3% after Mizuho initiated coverage on the stablecoin issuer and gave it a sell rating. The firm says that Wall Street's revenue expectations are way too high for the company, citing rate cuts coming and also rising costs from its partners like Coinbase. They are setting an $85 price target on this stock, which is much lower than the current levels. And we end with Tesla, worth taking another look at. It is still up about 1% here in the pre-market after it fell 6.8 yesterday on that news that Elon Musk was forming a new political party. And this is coming as we get a new note from Dan Ives calling this the tipping point for Tesla, saying that the board needs to act now and set the ground rules for Musk. John.
Yahara, thank you. Thanks for this morning. That stock bouncing back by 1%. Let's turn to fixed income and get to the bond market. Yields for 10s and 30-year treasuries climbing to the highest levels in more than a week ahead of new auctions as the June payrolls report pours some cold water on rate cut bets. Joining us now is Ira Jersey of Bloomberg Intelligence. Ira, let's just start with the rate cut bets and deal with the front end of the curve, and then we can deal with some of the supply we might get in the next few weeks. It feels like after the data on Thursday that we were pricing out rate cuts, not pricing them in. At the same time, a lot of economists said the details of that payrolls report were actually quite fragile. So what's the outlook for rate cuts look like from where you stand now?
Yeah, so well, I actually think that we're not going to see any rate cuts until probably the fourth quarter of this year. Just it has to do with data timing mostly, and also the continued fear over how tariffs are going to affect inflation expectations more than anything. But the market certainly has priced out and then now has priced back in a possibility of a September rate cut. So we're still, interestingly, we're still only pricing 50 basis points of rates cuts for this year. It's just a matter of when they start, right? So do they start in September and then the Fed pauses and then goes again in December, or do they go November, December? And that's basically been or I should say late October actually is when the Fed meeting is. So the market's kind of worried more about the start of it rather than the magnitude of cuts.
Ira, we've been worried also about the supply, so let's go through some numbers. We get something at the front end today, 3-year notes, $58 billion worth. As we work through the week, 10-year notes, 30-year bonds as well. Ira, I've heard a lot of caution around this story. Lisa's been talking about it continuously for good reason. Have you seen any concern in the actual auctions, though? Any concerns around getting the supply to clear, getting it away?
The June auctions went very well, actually, particularly for the longer end of the yield curve. And I think as we approach that 5% level, we'll see some, on the 30-year bonds, we'll actually see some decent demand there from the liability-driven investors, so things like insurance companies and overseas pension funds. But this tariff situation does have some of is rhyming with what happened in April, and this fear that Asian investors in particular, who are pretty big buyers of the long end of the Treasury curve, might actually start to pull back on the amount that they purchase. And if that's the case, then that's why we watch these auctions to see, do we have demand in the primary market? And I think threes today probably come and go without too much difficulty, but certainly Thursday's 30-year auction will be the one that really will be keenly focused on to see if we do have a lot of what we call indirect demand. So these are demands from investors who bid through third parties. So watch that metric as a key to the strength of demand at that 30-year auction.
Ira Jersey of Bloomberg Intelligence. Ira, thank you, sir. Yields are rising this morning by 4 basis points on a 10 and 30-year. The 30-year about 4.95. Lisa, $22 billion of 30-year bonds coming in 2 days' time.
And it's especially concerning, to Ira's point, the international picture isn't exactly constructive right now. There's a question about international buyers and whether they get demand at home or whether they see opportunity at home. I'm looking right now. If you look at Japanese 30-year bonds, and I know you're thinking, why am I mentioning that? But yields are actually climbing back toward the all-time highs, above 3%, on this fear that Japan might have to borrow more money to plug gaps in the economy from the tariffs, any kind of slowdown. So this is a really interconnected and global story.
It's a global story. Well said. It's certainly not just the US. It's the UK as well. We saw some of that in the last week too. Looking ahead to some economic data later this week as well. Jobless claims coming up in a few days' time. Jobless claims have been OK. They've come back down to 233. The estimate for Thursday is 235. Joining us around the table to discuss the labour market is Michael Reid of RBC. Michael, good morning.
Good morning. Thanks for having me.
Let's talk about the problems and where the problem is. Is it a demand-side issue or a supply-side problem? What is it?
Right now, we see it as a supply-side issue. And that's not to say the demand side is certainly slowing. It is. But what we're looking at is a situation where we have a record number of retirements, and that really has shown up in the data in various ways the past couple of months. And on top of that, you have the immigration inflows that are slowing. So that's really reducing the supply of workers who are available to fill the job openings that we have.
That said, some people say, well, there's almost half the population or 4/10 of the population that's out of work or just permanently unemployed. Why can't they get back into the workforce and just take up some of these jobs that the immigrants are leaving behind?
I mean, that's easier said than done. If you think about who's out of the labor force, there's a lot of reasons. First and foremost, you have folks who've retired, and they're at the point in their lives where they don't want to work anymore. Secondly, you have folks who have various family reasons, whether it's caring for children or a growing number of folks who are citing reasons, growing for their aging parents. So that's another reason why people aren't able to enter or re-enter the labor market. And then lastly, a big bucket of workers, or I should say a big bucket of folks who sometimes are workers but later in life exit the labor force, are really those persons with disabilities.
So if you look at this, I guess that a lot of this is really difficult for people to understand, especially at a time when college graduates are having a hard time getting jobs. You think, okay, people can paint a nice story for why the labor market's actually pretty tight, but it's not showing up in terms of the opportunities that it feels like there are right now. What's the explanation for that?
Yeah, so the way we think about this and what we measure is the matching of college graduates in terms of their degree and the job openings that we see. So if you have folks that are graduating, say, for example, with degrees in business or in engineering, but the job openings that we're seeing are in healthcare, for example, they're not going to be able to be employed in that sector necessarily. They'd have to go back to school and get a degree that aligned with that. So there is a bit of that structural mismatch in terms of the skills. And then on top of that, you have some geographic mismatches, wherein the jobs that are open, you don't have graduates necessarily who live or want to go to that area for various reasons.
What about wages? The Treasury Secretary talks about when you close the border, Americans get higher wages. Are you seeing any evidence of that?
Well, what we're seeing right now is that the cohort that is benefiting the most due to slowing immigration is the folks who don't have a college degree. So really folks who maybe went to high school and are seeing more opportunities as a result in sectors like construction or leisure and hospitality.
So they're coming in and filling these jobs that were formerly filled by immigrants. In that respect, then, are you concerned about the inflationary impact of a wage spike spiral?
So some sectors, yes, there's still very much strong demand. So let's talk about leisure and hospitality for a second. That's a sector that's really being driven by that retiree cohort that I mentioned earlier. Those are the folks who really we think are responsible for a lot of the travel, whether it's airplanes, stays at hotels, dining out, et cetera. So there's very much a strong demand for those services. And we're seeing that there is still wage pressure there. And when you look at kind of that pre-COVID path for hiring in that sector, we're still short where we should have been absent that disruption.
As I hear you describe some of the issues and some of the forces in the labour market right now, they sound more structural than cyclical. Does that lead to a different outcome at the Federal Reserve? How do they approach that issue?
Absolutely, and I think that's what we're trying to figure out right now. So there are some cyclical forces at play, but they're rather muted right now. We are looking for some potential layoffs in trade-related sectors, but we're just not seeing that yet. As you noted, jobless claims are still very low. So now you have to think about kind of that natural rate of unemployment, NAIRU, right? And where that is relative to the unemployment rate now, they're quite close, but should we be thinking about NAIRU perhaps being a bit lower given the conditions that we're looking at? Less immigration and a large retiree cohort. So maybe we're right there. And that begs a question for the Fed. Do you want to start cutting now where you think NAIRU is perhaps right where we are at 4.1%? Do you think NAIRU is perhaps a bit higher at 4.3%? Are they willing to accept a bump in the unemployment rate? So I think that's part of the debate for the Fed. But at the end of the day, when you have a 4.1 unemployment rate, it's really hard to justify interest rate cuts.
This goes back to something we said earlier on in the programme. When they get together in September, what they wanted in September was several months of inflation data off the back of a final decision on tariffs. They're not going to get that several months anymore. If we get a tariff on August 1, they'll only have a handful of months. Look, when you look at that situation, Lisa, the only way they can cut interest rates based on the threshold that they've established is if they can no longer stand there and say the economy's solid, we can wait. If they have to say the economy's starting to crack, we can't wait anymore, that's the reason to cut interest rates.
They have to see the unemployment rate go up significantly, and that's not what we're seeing. And frankly, what we just heard from Michael Reid, to me, highlights why we're not seeing that increase in unemployment, even though it seems like companies aren't hiring quite as much. You've got the cyclical changes and you've got the structural changes, and you put them together and you say, what can the Fed do? How does the Fed respond? Well, they can't go out and train people. So how do they sort of use policy
to deal with something that is pretty profound.
And still not that well understood at the
Exactly.
moment, at least. More jobs data later this week. As I say, initial jobless claims dropping on Thursday morning. Michael Reid there of RBC Capital Markets. Michael, thank you, sir. Appreciate it. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Lizzie Burden. Hey, Lizzie.
Hi, John. President Trump hosted Israeli Prime Minister Benjamin Netanyahu at the White House last night. The Israeli leader told Trump he'd nominated him for a Nobel Peace Prize. The US is pushing for a ceasefire in Gaza that could end more than 18 months of fighting and see the release of the hostages still held by Hamas. Elsewhere, Apple's top executive in charge of AI models is leaving the company for Meta. Sources telling us here at Bloomberg that Ruoming Pang is joining Meta's new superintelligence team after being offered a package worth tens of millions of dollars a year. And Shein confidentially filed for an IPO in Hong Kong. The Financial Times reporting that the fast fashion retailer sought the China Security Regulatory Commission's approval for its listing. Shein had filed for an IPO in London about 18 months ago, but has been unable to secure regulatory approval. That's your Bloomberg Brief. John.
Lizzie, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with Lynam of BlackRock on the risk of being too defensive. That conversation up next. Live from New York. You're watching Bloomberg TV. Abramowicz getting absolutely hammered in the commercial break. This continues.
I will get TSA approval. Listen, I don't need to be anyone's charity case. I don't need to get your guest passes
We're
for
going
Clear.
to crowdfund this now.
We're not going to crowdfund my TSA approval. Let's move on.
Chaos this morning. Let's move on. Equities on the S&P just about positive by 0.1%. April 2nd was absolute chaos. April 9th, we've got a 90-day extension. Before we even arrive at July 9th, we've had another extension of 3 weeks. We'll see you again on August 1. Equities positive on the Nasdaq 100 by 0.2%. That's the price action as we count you down to the opening bell. Your trading diary for the week ahead is shaping up as follows. At 11 a.m. Eastern Time, we'll hear from the President of the United States holding a cabinet meeting on Wednesday, Fed minutes. On Thursday, earnings from Delta Airlines, plus an important round of jobless claims, which retreated just last week, and we'll see if that continues for the weeks ahead. More comments from President Trump expected in a few hours' time then. More letters expected as well. Bloomberg's Tyler Kendall joins us now for the latest. Good morning, Tyler.
Yeah, hey, John, good morning. Well, we're not just waiting on President Trump to speak at 11 a.m. Eastern because he's convening his cabinet, which often means that he goes around the room and he has officials give updates in their particular area of expertise. We are expecting some of those top trade officials that we watch closely to give updates as well, including the Treasury Secretary Scott Bessent, the Commerce Secretary Howard Lutnick, and the USTR Jamison Greer, who we all are understanding have been holding these trade negotiations in recent days ahead of this 3-week extension that we've now been given. We've been talking a lot about those countries that did get letters like Japan and South Korea, but we are on watch for if any other ones will get letters too, because it's been interesting to hear from sources familiar telling Bloomberg News that some countries actually appear on the cusp of perhaps some framework agreements, including Taiwan, India, and also the European Union, and what's really been a reversal of favor for the trading bloc. But John, people familiar tell us here that ultimately to get some sort of monumental breakthrough in order to announce the agreement, that was going to be very difficult to reach by the original deadline of this Wednesday, July 9th.
Tyler Kendall, thank you. Monitoring the latest down at the White House with the President of the United States. I have to say that's been a surprise for me over the past few months, the fact that Europe's no longer back of the line, that they might just accept the 10% with some exemptions and we move on.
And it was a reversal from Europe as well. They were not willing to at first deal with the 10% across the baseline tariff. They were going to come out and retaliate. It's interesting because basically Europe and Japan have swapped places in terms of where they are in the order and basically the willingness of this administration to do a deal.
That's the situation in Washington. Here's the view on Wall Street this morning. Lynam of BlackRock writing the following. We expect episodes of macro volatility. We remain attuned to the opportunity cost of being too defensive and under-risked in this environment. Amanda joins us now for more. Amanda, good morning.
Good morning. Thank you for having me.
Great to see you. The risk of being too defensive with stocks at all-time highs and credit spreads near the tights for the year.
Yep.
Explain, please.
So I think in a time like this where there's a lot of uncertainty, often the reflex from investors is to just generically move up in quality. And we've been pushing back against that and basically saying that there's a case for selectively moving down in credit quality. If you look, for example, high yield total returns have outperformed investment grade year to date. Subsets of high yield, including double Bs, have outperformed triple Bs. So I think what the market is telling you is that, yes, we're expecting volatility. There's residual uncertainty. But if you focus on kind of back to basics credit work, companies are navigating this. And we are paying incredibly close attention to the micro level commentary of companies in this environment. And I think what the market is actually seizing on is companies guiding towards 2026 and 2027, outlining all of the operational levers that they can pull to navigate this uncertainty. And I think that's what's giving some comfort. Now, is there a lot of scope for spread tightening? No. But our income, our all-in yields in corporate credit still attractive? Yes. And I think that's really what we're emphasizing.
That's exactly what I wanted to ask you, the idea that spreads are near all-time tights on high-yield bonds. You're not getting compensated in addition to treasuries that much at all relative to history. Why doesn't that worry you?
Well, there is some market segmentation there. So the trade-off between treasuries, yes, the spreads are tight, but back in late 2024, we've characterized that as warranted resilience. So those spread levels, there are a host of reasons, macro, fundamental, technical, why those spreads can remain in that tight range. I think from our perspective, when we talk to investors, they're looking to deploy capital into corporate credit. And so what we're really saying is if you're buying corporate credit, buy it for the income, the carry, the yield, not for the potential total return boost from tighter spreads. And I think really the point we're just trying to make is if you're waiting for a sustained sell-off in credit spreads, we view the bar for that as pretty high.
So it's pretty remarkable that not only is this not April 2nd, but that here we are with yet another trade war brewing and escalate to de-escalate. And not only are people not getting bearish, we've got David Costin over at Goldman Sachs upgrading his S&P forecast. You've got an upgrade over at Bank of America. And here you are in the credit space at BlackRock saying there's a risk we're not getting risky enough. And that essentially that's what we have to go. Are we just discounting the policy uncertainty entirely? Is that sort of been stripped out of the picture?
We're not discounting it. The title of our third quarter outlook, for example, was two-sided risks. So we're absolutely recognizing that there's still a lot of uncertainty. There are still a lot of potholes that we need to navigate in this environment. What we're saying, however, is that the economy has shown relative resilience. And so taking a complete risk-off posture, in our view, isn't the way to go. In fact, again, going back to the lower-rated pockets of the corporate credit market, they've outperformed. It kind of reminds me of in the early stages of the Fed's rate hiking cycle when rates were being hiked significantly and there was an expectation in Europe and the U.S. that it would lead to an imminent recession. The economy surprised to the upside. I feel like that's a little bit what's happening in the corporate sector, is that it's actually turning out that corporates have a lot of levers to pull to navigate this. Some are within product mix, some are vendor relationships, inventory purchases, and so they're actually navigating this. And I think the bottoms-up credit work is signaling that there is a little bit more resilience, I think, than many expected. That does not mean, however, that we are expecting a more challenging growth inflation mix. So that doesn't mean that we aren't expecting some softening in the data from here.
Were you able to get to this point because we saw reversals from this administration when the market pushed back on some of their policy proposals?
I think we got to this point because companies have been a little bit more forthcoming about the options that they have at their disposal. And so when you look at retail earnings, for example, over the last month, some of these retail companies have actually guided towards they can actually offset the full cost of tariffs starting in 2026. Yes, there may be some near-term volatility and some near-term headwind, but I think those sort of concrete details are what's giving investors the comfort to actually do the bottoms-up credit work. That doesn't mean that all these companies are created equal. There will be some winners and losers in this. But I do think it's hard to ignore when companies actually present that full suite of levers.
Do we need Chairman Powell to cut?
I think that's probably more of a boon for the equity market, frankly, than the credit market. I think actually if rates stayed in this regime, that's a pretty supportive technical for corporate credit in terms of all-in yields. There's been some increase in default rates, but by and large, companies have incorporated that higher borrowing cost. So I don't think it's a prerequisite for continued resilience in corporate credit. I think maybe the equity market might be disappointed a little.
We can live with rates in the fours on Fed funds.
Yes, I mean, you've seen some floating rate borrowers default, but those are largely repeat defaulters. So by definition, that should have been priced into the market. I think ideally it would be nice to have some additional normalization cuts, but you know our view, we're not expecting easing. So I think that's really the base case for us.
What you just said there was fascinating, that any kind of rate cuts would help the equity market more than the credit market. Is the credit market now a clipping the coupon, all-in yield story, period, full stop. And if rates go down, that will be challenging in terms of justifying why you should purchase credit at these spreads.
I think psychologically there is some hesitation for investors if we would see, for example, high yield all-in yields below 7%. Right, that kind of gets some attention. I do think that it's more of a why are you buying credit for carry, for income, for yield, not for the total return boost from tighter spreads or lower rates. That's historically been the driver of total returns, not our real view in this cycle. For sure, it would help fixed rate, long duration product. But I think if you look at the fact pattern of inflation above target, growth holding in, still residual uncertainty, the commentary from the Fed, we're not expecting the first rate cut until the fourth quarter. So really, that's kind of our base case.
We heard that again earlier this hour. Amanda Lynam of BlackRock. Appreciate it. Thank you. Amanda Lynam there on the latest. You mentioned the upgrades from Goldman and Bank of America. I think we should call them what they are. Market to market, just a little bit, right? Both their year-end price targets were below where the market is right now.
They're market to market. It's slightly above where we are right now, at least when you look at Goldman Sachs.
Yeah, 63 and 66 at both of those banks, yeah.
So you could say this is just market to market, but the timing is remarkable. I mean, you have to just say they're coming out with this on the same day that we're reigniting the trade war, maybe, but the market's ignoring it, kicking the can, and it's just sort of notable.
Credit to Chris Harvey of Wells Fargo.
Yeah.
Just stuck with 7K. Never changed his price target.
I thought that was great. By the way, parenting tip, I'm going to start sending letters. If they misbehave, I'm going to send
to the kids.
To the kids.
Stating the same thing, just with an extension.
Exactly.
Do you think the behavior is going to change?
Thank you for attention to this matter. I hope so.
You think they're going to adapt and adjust to
You
that?
have until September 1st to change your behavior.
See how that works out. Or back to school for you, which is where they're going anyway. From New York City, we've got a new deadline. It's August 1st from New York. Good morning.